Good morning. We'll call to order the August 16, 2023 Mendocino County Board of Retirement meeting. We can start with the roll call.
Here.
Okay. One moment, let me find a pen. I got one, thank you. Okay. Mr. Kelly.
Here.
Ms. Cavanis.
Here.
Mr. Jurdy.
Here.
Mr. Cromer.
Here.
Mr. Shoemaker. Absent. Ms. Harris. Mr. Anderson is absent today by prior arrangement. And Ms. Cubison.
Here.
Thank you.
Thank you. That takes us to the Pledge of Allegiance. Trustee Land, would you lead us? To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. That takes us to public comment. So we have an opportunity for public comment for items that are not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda at this time. Do we have any public comment at this time, Ms. Zeller?
Does not appear to be any public comment.
Chair Cromer, if I could just mention that we will have the board's performance evaluation survey going out after today's meeting for results to be compiled and presented to the board at the October-November meeting. So just keep an eye out for that. I just wanted to give people a heads up that it's coming.
Thank you. I appreciate that. Item number 1 will be the swearing in of new trustee Charles Kelly, which will be conducted by Ms. Zeller.
Charles, would you like to stand? I, Charles Kelly, do solemnly swear that I will support and defend the Constitution of the United States and the Constitution of the State of California against all enemies, foreign and domestic, that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the State of California, that I take this obligation without any mental reservation or purpose of evasion, and that I will faithfully discharge my duties upon which I'm about to enter. I hereby attest that as a member of the Mendocino County Employees Retirement Association Board, I will carry out my duties and responsibilities with respect to the Mendocino County Employees Retirement Association in accordance with the highest fiduciary standards and in compliance with the laws, regulations, and policies applicable to the Mendocino County Employees Retirement Association.
I so affirm.
Thank you.
Thank you and welcome. That takes us to item number 2, which is the consent agenda. All matters on the consent agenda are approved by unanimous consent unless there's a trustee that would like to request separate action on any of those items. I'm not seeing any requests, so item number 2, the consent agenda, will be approved by unanimous consent. Item number 3 is discussion and possible action regarding investment matters. I see that we have Claire Gregg from Callan online. Welcome from Callan.
Well, thank you so much.
Good morning.
Good morning, Greg and Claire.
All right. Well, I'm glad to kick us off here today. We've got kind of 2 key topics on the agenda to review with you. The first, of course, is quarterly performance. So I'll walk through some of the summary performance materials to look at how the Mendocino investment program fared through the first half of 2023. So starting with capital markets and then moving specifically into the MSERA investment portfolio. The other key topic to talk about today is the domestic equity structure review. So as you all know, we conducted an asset liability study about a year ago. There were ensuing discussions about the right asset mix target, how much in stocks, how much in bonds. And the next piece of the discussion is looking at each asset category individually. So today we'll be talking specifically about domestic equity, how you've currently structured the portfolio, what changes you've made over time, and what you could consider on a go-forward basis as well. Are there any questions before I dive into the performance review?
I'm not seeing any, Claire. Go ahead.
Great. And Judy, are you gonna share screen? You might already be sharing screen and I just don't see it.
I can put that up for you, or you do have the ability to share screen, but we are not seeing it here.
Okay. If you'd like me to do it, I can do that. Oh, Robert's ahead of me. Okay, great. Thank you, Robert. So I'll start on page 3, backing up a few pages here. As always, we've included a number of slides here just as a snapshot of the capital markets for context of the performance that we'll see for the investment program and the individual managers. So where were we as of the end of June? And I think it's worthy of noting that one of the biggest changes since the last time we met is that suddenly a recession in the US doesn't appear quite so imminent. So despite the aggressive rate hikes that we've seen, the most aggressive rate hikes over the last 15 months since 1980, the probability of a soft landing seems to be coming into view. It seems more probable than it did even just a quarter before. From an economic standpoint, the labor market remains strong, consumer spending has exceeded expectations, and importantly, we've seen signs that inflation is moderating. We've also successfully weathered a couple storms this year already. So regional bank worries. We've also gone through the debt ceiling saga. That's at least currently behind us. And all of this together, when we look at performance of the investment markets through the second quarter, meant that investors were generally optimistic through the second quarter. So you can see that here in the absolute performance return numbers of the various indices across the page here. Stock indices, as you can see, both in the US and non-US, posted strong second quarter gains. And risk appetite was actually also evident within the bond market, even though we see a modestly negative return here for the Bloomberg Barclays aggregate in the quarter. Starting with the second line here, kind of at the top of the page, the S&P 500 index posted its third straight quarter of positive performance. It was up about 8.7% in just the second quarter of 2023. So putting those 3 quarters of positive returns together, just one column over to the right, you can see the last 3 quarters together meant a positive 25.7% return for the S&P 500 index. Now, importantly, that's coming off a pretty dismal prior 3 quarters, which is in the column just to the right of that, down about 24%. That was the first 3 quarters of 2022. But notably, the markets made up a significant amount of the ground that was lost in 2022. And we all remember how painful that was in the absolute numbers. Small cap markets were also up. So the Russell 2000, representing small cap US stocks, was up 5.2% in the quarter. And for the last 3 quarters, that's about a 15% gain, coming off a 25% loss in the prior 3 quarters. So small cap stocks also rebounding, but not quite to the extent of large cap stocks in the last 3 quarters. Non-US stocks were also positive. Developed markets in particular posted notable gains, up about 3% for the quarter. Emerging market stocks Still positive, but much more muted than developed market stocks, so of about 90 basis points in the recent quarter. Over the last 3 quarters, the broad non-US market up about 29%. Pretty notable recovery from the prior 3 quarters that we saw, the first 3 quarters of 2022. And then again, emerging market stocks up about 15%, similar return to what we saw for small cap US markets over that 3-quarter period, but off a 27% loss from the prior 3 quarters. Moving down to fixed income, the Bloomberg Barclays Aggregate, which is the benchmark for your 2 core plus bond managers, PIMCO and Dodge & Cox, was down 84 basis points for the quarter. A positive return over the last 3 quarters, up about 4%. So I mentioned that we did see kind of a risk appetite returning within the bond market as well. That's really apparent when you look kind of sector by sector. Corporate bonds did well, high yield bonds did well, securitized mortgages did well in the quarter. Notably, real estate remains negative. So if you'll remember in 2022, the equity markets were down, public equity markets were down, and real estate continued to turn in a positive return, real estate and infrastructure. The real estate return markets have lagged the public equity markets, which is not a surprise. So we continue to see negative returns within real estate, certainly affected by the higher interest rates. And that actually did have an effect on your portfolio in the recent quarter and year. Because if you think about the equity markets dropping in 2022, that meant you were overweight to real estate and infrastructure. Now, as we've seen that reverse, going into that reversal overweight means that having an overweight to real estate was a slight drag with those negative returns on your portfolio in the recent quarter and year. So we'll take a look at that in more detail in a few pages. Robert, if you'll flip ahead 2 pages to page 5, we focus in a bit more on the US markets. So a couple things to note here. The main one being that the second quarter was really a story of large cap technology stocks. So you can see at the bottom of the page here, information technology. We break out the different sector returns within the S&P 500 index. And information technology was up 17% in the quarter. Compare that to a few sectors to the left. Energy down slightly, financials up 5%, healthcare up 3%, but much more muted returns than what we saw from information technology, communication services, consumer discretionary. That's important because technology, communication services, consumer discretionary, those are traditional growth-oriented sectors. Energy, financials, healthcare tend to be more prevalent within value indices and value-oriented portfolios. So we saw a significant dispersion between the growth indices and value indices, both for the quarter and for the year. So if you look at the chart on the top right, you can see the Russell 1000 growth was up 12.8% in the quarter. The value index up 4%. So still a strong return, but a significant dispersion there between growth and value. And that's apparent over the last 1-year time period as well. The aptly named Magnificent Seven. So when we think about the big drivers of that IT bucket, NVIDIA, Facebook or Meta, Amazon, Tesla, Apple, Microsoft, Alphabet or Google, those 7 stocks comprise roughly 25% of the S&P 500 index and have actually accounted for the vast majority of the S&P 500 gains in 2023. So those 7 stocks have been up 64% versus 3% for the rest of the index. So that's pretty interesting to think about what's driving really much of the returns that we're seeing out of the US equity performance. Moving on to page 6, just a quick note on non-US markets. Again, in a bit more detail here, I mentioned non-US markets were also positive, posting notable gains for the quarter and for the year. But style impacts were much less muted within non-US markets. So growth and value being a bit more in balance, each up about 3% in the recent quarter. And you'll see that when we look at the performance of the international equity investments within your portfolio. The growth-oriented and value-oriented managers didn't see as much dispersion as we saw within US value-oriented and growth-oriented managers in the quarter and year. But where we did see a notable divergence was between developed markets and emerging markets. So I noted kind of the broad market returns earlier, but a key component of emerging markets is China. China makes up about 30% of that index, and China was down significantly in the quarter, down about 9.7%, down almost 17% for the trailing year. So overweight or underweight to China could have a significant impact on the relative returns of active managers within that category. Again, also relevant to your emerging markets manager, 91. Lastly, here on page 7, the fixed income market. Again, total returns within fixed income down modestly, reflecting continued raises in interest rates. But as I mentioned previously, we did see risk appetite within the bond market. At the top of the page here, you can see corporate excess returns, mortgage excess returns, and high yield corporate excess returns. So did see outperformance among those sectors. That was positive for Dodge & Cox and PIMCO, your Core Plus bond managers, who both did outperform, having overweights to those asset allocations within their portfolios. Shifting to gears to look more specifically at the Mendocino County investment portfolio, page 9 captures total asset growth in the portfolio. So at the top of the page here, we have a line chart that shows asset growth in the portfolio over the last 15 years. The bottom half of the page focuses just on the last one fiscal year, so June 30, 22 to June 30, 23. The top of the page, of course, showing the significant asset growth that the investment program has experienced over the last 15 years, the successful investment results of the program. The bottom half of the page notes that as of June 30th, 2022, the plan had $622 million in aggregate. Over the course of the last fiscal year, and I'm looking just at the bottom line here, the plan experienced $51 million in aggregate investment gains, so making up significant ground from what was lost in 2022. About $9.5 million left the plan to pay benefits, and the plan ended the quarter with almost $664 million in aggregate. So it was a pretty good fiscal year. If you look just at the net new investment column, you do see some asset movement among asset categories, reflecting effective rebalancing that took place over the course of the year. Money moving into infrastructure and domestic fixed income, largely out of equity and real estate over the course of the full year. Flipping one page ahead, we look at the actual asset allocation of the plan versus the strategic target as of the end of June. And importantly, these two pie charts are really right in line. So Robert has done a good job following all of the discussions of how the total asset allocation of the plan should be positioned. Robert's done a great job of getting these two pie charts back in line, ensuring that the actual asset allocation of the plan is as closely in line with target as possible. What you'll note is that the plan is just slightly overweight to real estate and infrastructure. So about 12% allocated to real estate versus the 11% target, 8% in infrastructure versus the 6% target. Both of those allocations certainly within the range of the appropriate or of the target ranges specified in the investment policy statement. And those are balanced by very slight underweights within equity. So 1% underweight domestic equity, 1% international, 1% underweight public fixed income. Those are very slight differences. So the reason I point it out is because those slight differences actually did make a difference in relative returns for the recent quarter. So I mentioned earlier that real estate was negative in the quarter and the year. Public equity rebounded, and just those slight dislocations, again, still well within the appropriate ranges as specified in the investment policy statement, ended up being a slight headwind to relative performance. So I point that out here, but we'll look at that in more detail on another slide. I'll flip ahead a few pages in the interest of time to page 13, where we show the detailed asset allocation of the plan as of the end of the quarter and how that changed over the course of the previous quarter, so from the end of March to the end of June. In just the last quarter, the plan saw approximately $18.7 million in aggregate investment gains. About $1.5 million left the plan to pay benefits and expenses. And the plan again finished the quarter as of June 30th with $664 million in aggregate. You can see in that net new investment column, again, a little bit of rebalancing activity that occurred following the decision of the board to maintain the strategic asset allocation that was in place for the last 3 years. So Robert doing good work to get the portfolio right in line with that target. And then if you look down the page in terms of balance between growth and value within each individual asset category, those two remain in balance, which is good to see. On page 14, we get to performance. So this is performance for the total fund as of June 30th and over the recent quarter, year, and longer trailing annualized periods. In the recent quarter, the total fund was up 2.9%, just behind the strategic target return of 3.1%. Over the last year, the plan returned 8.3%, beating the strategic target on a net of fees basis, which was up 8.2%. If we look over longer annualized time periods, the plan has done quite well, turning in notable gains across the board over those longer time periods. But what really jumps off the page to me here is that every return is positive. So if you look specifically at the last 3 years, the plan was up 8.8% annualized over those 3 years. But if we think about what went into that, that's 2020, 21, 22, and the first half of 23. We know that there was significant volatility within the portfolio. There were notable periods of down markets as well as significant rebounds. And so it's pretty remarkable to me to note how that's evened out to an 8.8% annualized return. A pretty good result through all of that volatility for the total portfolio. That result, again, outperformed the strategic target and actually fared really well versus a peer group of other public defined benefit plans. So landing in the 16th percentile of that peer group over the last 3 years. Longer term 5, 7, 10, and 15-year results also faring well versus the strategic target, as well as versus this peer group of other public defined benefit plans. Individual fiscal year returns are captured on pages 15 and 16. Here on page 15, again, the trailing 1 year return was a full fiscal year for the plan. So that 8.3% return that we looked at for the trailing year is the 2023 fiscal year return. A great result coming off a negative fiscal year return for 2022. When we look at each of those two results, while very different in absolute terms, I note that they both landed pretty close to the median of the peer group. If we look back over the prior 8 fiscal years, there was more of a pattern of being, top dot or within the bottom quartile of the peer group. So there were changes made to the portfolio, of course, in the last 3 years, with a key goal of being, kind of removing some of the higher volatility that we'd seen within the portfolio. And I think that's been effective thus far, though just a short time period. One other thing to note when we look at these last 10 fiscal years of performance is that 8 out of 10 have been positive return years. So in 8 out of the last 10 years, the portfolio has seen gains. And in some of those fiscal years, quite notable gains, particularly 2021. The 2 down years were the fiscal year of 2016, and then as we previously looked at, fiscal year 2022. Moving ahead to page 19, we look at attribution. So what drove relative returns in the recent quarter and year? So focusing in on the more short term. In the recent quarter, as I mentioned, the total fund was up 2.9%, slightly behind the strategic target return of 3.1%. The key headwind to performance, relative performance in the quarter, was asset allocation, so detracting about 25 basis points. And I alluded to this earlier, but it's just those small, 1% differences from the strategic target that actually drove that slight underperformance in the quarter. In aggregate, the active implementation of the asset categories was slightly positive. So a slight overweight to real estate, balanced by an underweight to public equity, again, drove that just very slight underperformance versus strategic target in the quarter. For the last year at the bottom of the page, so this is the fiscal year, again, the plan was up 8.3%, outperforming the strategic target, which was up 8.2%. And that outperformance was driven by the active implementation across the individual asset categories. So the manager effect accumulating to a positive 1.3% of outperformance versus target in the year. Asset allocation effect, again, was negative for the last year, the key driver of that being the overweight to real estate. So kind of a denominator effect as equity markets went down, and then as we saw the reversal of real estate markets being negative and equity outperforming, again, that's the key driver there of that asset allocation effect. Page 20 looks more specifically at the performance of the individual investment managers within the program. I mentioned before, Greg's going to spend a fair amount of time today talking more specifically about the implementation of the domestic equity asset category as a whole. But importantly, for the last quarter, year, 3, 5, 7, 10, and 15-year time periods, you can see the aggregate performance of this asset category right there at the top. In the last quarter, domestic equity composite was up 7.5%. And that trailed the Russell 3000 index. For the last year, it was up 17.6%, also trailing the Russell 3000 index, which was up 19%. So quite a notable gain over the last year, but did trail the Russell 3000. Now, the key driver of that within the domestic equity composite was actually the strategic overweight to small cap stocks. We'll talk a fair amount about that in the domestic equity structure review, but your managers have done pretty well over the long term, some mixed performance in the last quarter and year, but that overweight to small cap stocks, where large cap stocks have really dominated, was a headwind to the performance for the composite in the recent time periods. Your mid-cap managers, specifically the Fidelity Low Price Stock Fund and the Janus Enterprise Fund, did underperform their respective benchmarks in the recent quarter. Fidelity outperformed for the last year. Janus underperformed for the last year. But over longer 3, 5, 7, 10, 15-year time periods, both managers have outperformed their benchmarks over all of those annualized time periods. Within small cap, more mixed results from a relative perspective versus their respective benchmarks. But ultimately, these two managers have been really good complements to each other over time. And one thing we'll look at later in the presentation is actually performance for the small cap composite. So putting these two managers together. Prudential has historically been a true deep value manager and has stuck to that style orientation. AB US Small Cap Growth has been a true small growth manager and has stuck to that growth orientation over time. And as those two styles have come in and out of favor, these two managers together have actually managed outperformance for the total small cap composite. Page 21 covers performance for the remainder of the managers in the plan. So international equity is at the top of the page. International equity has historically been the most challenged asset category from an active implementation perspective for the Mendocino County Investment Program. However, the international equity composite has had a great year and 3-year time period. So certainly pleased to see that performance improve in the last 3 years. In the recent quarter, international equity, all of your managers together were up 2.4%, slightly trailing the MSCI ACWI ex-US index, which was up 2.7%. For the last year, the managers in aggregate have generated a gain of over 14% versus a 13.3% gain for the index. Again, over the last 3 years, also outperforming, up 8.2% versus 7.8% for the index. Longer term 5, 7, and 10-year returns do trail that index, outperforming over 15 years. But again, the relative gains that we've seen in the last 3 years have helped to support some of that performance. As we look down at the individual managers within the international equity category, again, the last quarter and year have been quite good for the majority of them. I mentioned previously that we saw muted style differences when as compared to what we saw within the US markets. So if we think about the individual managers, Euro Pacific Growth, Harbor International, Oakmark International, and Mondrian, 2 of those managers have a bit of a growth tilt to them. 2 of them have a value tilt to them. But when we look at performance for the last quarter, there wasn't too much divergence driven by those style tilts. 3 of the 4 did outperform in the quarter, and 3 of the 4 outperformed in the last year. All of that, again, leading to outperformance over those time periods. You also have dedicated managers within small cap and emerging markets within the non-US equity composite. The T. Rowe Price Small Cap Fund has trailed its respective benchmark over the last quarter and year, which is weighed on 3-year performance as well. A part of that has been an overweight to China. So I mentioned earlier that China makes up about 30% of the emerging markets index. The T. Rowe Small Cap Fund does have an allocation to China within the strategy, and that overweight has been a headwind in recent time periods. Still, since addition to the program, it has outperformed its index over the last 5 years, so up 2.9% versus 2.6% for its respective index. And then emerging markets, the 91 strategy, overall, we do expect this strategy to struggle during inflection points. So when we put that into the context of the last 3 years, we've certainly seen a lot of volatility, a number of different inflection points. All in, that's meant underperformance in the last year, but over the last 3-year time period, it has kept up with its index. The fixed income composite is just below that. So the 2 managers of Dodge & Cox and PIMCO making up the total of the fixed income allocation within the plan. And both managers continue to do well versus the Bloomberg Barclays aggregate. In the recent quarter, both managers outperformed. But importantly, they remain good complements to each other. And so if we look at performance over longer time periods, together, the fixed income, those two managers making up the total fixed income composite have outperformed the Bloomberg Barclays aggregate over all time periods. Your infrastructure managers, JP Morgan and IFM, continue to provide good diversification to the plan. So as you know, that allocation in total, those two managers were added in the last 3 years, both of them being funded, or the program really being funded about 2.25 years ago when your capital was called. And that's been a really good decision for the plan. So over the last year in particular, those two managers have managed to post a return of nearly 10%. Again, providing significant diversification to the returns that we saw, particularly out of domestic and or particularly out of public equity over the last couple of years. And then real estate. Real estate was the one category of negative performance, as I mentioned before. For the quarter, the real estate composite down 3%. For the last year, down about 12.5%. We've seen the whole of the core open-end real estate market post negative returns in the recent year. So no surprise that your managers are also within that category, or also down double digits in that time period. We've also seen some divergence in terms of how managers are writing down the specific properties within their portfolios. So this is a category that we're watching pretty closely, but ultimately not a surprise that we're seeing negative returns there, particularly as the real estate market returns have lagged the public equity returns. Still over time, having the real estate component within your portfolio has provided good diversification, and your managers together have certainly been additive to the program, posting positive returns over all longer time periods. Page 22 is one that we brought about a year ago and said we would revisit this on about an annual basis. So this is what we call a manager monitoring summary. And importantly, we meet with you quarterly. We review the investment performance results of the total portfolio and all of the individual managers. But on an ongoing basis, Callan has a dedicated research team with professionals that are focused on each individual category, asset category. So domestic equity specialists, international equity specialists, fixed income specialists. And we're meeting with your managers on an ongoing basis, evaluating not only absolute performance and relative performance, but also keeping track of the organization, the team, what changes have happened at each organization or on each specific strategy team that we think are relevant to potential future performance. What about any changes to the philosophy or process? What's kind of our overall sense of the standing of each individual manager and strategy? And so this is a page that we designed to help communicate that to you on an ongoing basis, and we'll continue to refresh this, every few quarters, every year to bring it back forward. Importantly, when we look at, let's start with the legend, actually. So we've got 3 colors here. We call this kind of a stoplight report. And anything where we mark green means that that category is really within expectations from our perspective. So no concerns. Anything yellow is to mark a notable change. Not necessarily something that we're overly concerned about, but this is something we want to highlight to you. It's something we're watching and we'll continue to monitor. Doesn't mean you need to take action. Just want to make sure that it's that we're communicating those changes to you. If you saw red on this page, that would indicate something that we do have concerns about, and something that might be more of an action item for the committee. Importantly, you don't see any red here today. So there are a few areas where we want to highlight notable changes to you, but no red, no significant concerns from our perspective. If you look at the overall category, so that's on the far left, there are 3 managers that we've highlighted it as yellow. Everyone else is green within expectations. We continue to monitor them, but don't have any concerns or notable changes to highlight to you today. On the right-hand side of the page, we've highlighted kind of the key things that we're watching anywhere that there is a yellow box there. Again, going back to kind of the overall, Fidelity Low Price Stock is the first manager that we've noted as there's a notable change here and something that we want to make sure is on your radar, something you know that we're watching. This is actually not a new change. We talked about this last year as well, but there's a notable transition in portfolio manager that we've been monitoring closely. And that's the fact that longtime portfolio manager, kind of architect of this strategy, Joel Tillinghast, is going to be retiring at the end of this year. So Fidelity has implemented a transition plan to 2 new portfolio managers, Sam Shamvitz and Morgan Peck. And that transition has been in process, and we're kind of in phase 3 of 3 at this point, as we're in the second half of 2023. So slowly, Joel Tillinghast has been transitioning portfolio management responsibilities to the 2 new individuals, and he will effectively retire again at the end of this year, at which point Sam and Morgan will be wholly responsible for the portfolio management. Why we're watching this more closely? We appreciate that there's a long runway, but ultimately these are 2 new individuals to the portfolio that come with new perspectives. So we are monitoring how they're changing the portfolio, what their perspectives are, and how that might change the implementation of this strategy on a go-forward basis. Moving down the page, the next manager that we highlight overall is the Prudential Small Cap Value Fund. This is also one that we've been watching closely for a number of years now. So there was a bit of a pickup in turnover on that team in 2021 and also prior to 2021. The 2 key portfolio managers do remain in place on that strategy, providing some good stability to the strategy. But we've also seen trailing performance on a relative basis for some time. It's not out of line with expectations, particularly when value did rebound. We saw this strategy do very well. But we've seen the portfolio trail its strategic benchmark over long-term time periods for some time. So those 2 things together led to us highlighting this one yellow and something that we're watching more closely. The last one that we note in the overall category as yellow, something that we're watching more closely, is the Barings Core Property Fund. This is really related to performance. So a member of our real estate research team did attend one of the Mendocino meetings just last year, or in the last year, to talk more specifically about REEF and Barings, our overall opinions of them. And the Barings Core Property Fund, from a performance standpoint, has seen underperformance versus other core open-end real estate funds. And much of that has largely been driven by write-downs on 4 of their office assets in the portfolio. So office assets, as you can imagine, have been challenged within most core open-end real estate portfolios. And Barings has 4 in particular that have been a drag on their recent performance. That's something that we're in close contact with them on, something that we're monitoring and evaluating how that could potentially affect longer-term go-forward performance. So again, yellow, not red, but we wanted to highlight to you that that is an area of concern for us and something we might be talking to you more about in the coming quarters. The remaining highlights here include changes, some portfolio manager changes, but nothing that we're keenly, or investment professional changes rather, but nothing that we're keenly concerned about. If we work down the page quickly, AllianceBernstein Small Cap Growth, we are monitoring a portfolio manager change there from a co-portfolio manager structure to just Samantha Lau taking over as the portfolio manager for this strategy. We think very highly of her. This is something that we highlighted to you a number of quarters ago. but it's a transition that we continue to monitor, not something we're concerned about, just one we want to watch closely. Harbor International, so the underlying sub-advisor there is Marathon. We've highlighted this strategy just from a performance perspective. We have seen significant outperformance and underperformance from this strategy. That is consistent with what we would expect from the strategy. But given that it can result in extended periods of underperformance and outperformance, again, something that we keep an eye on closely for the portfolio. Mondrian has also seen disappointing relative performance over longer time periods. This strategy does tend to protect on the downside, which it did in 2022. But we do note longer-term performance struggles due to the strong upmarket that we've seen in the last 10 to 15 years. Dodge & Cox did see some turnover from an investment professional level, but ultimately that's the head of, or the director of fixed income, Tom Dugan, who has more of an administrative role from a fixed income perspective for Dodge & Cox. No concerns from our perspective on impact of that to the strategy. And then PIMCO also saw a portfolio manager change. Scott Mather, who had led the strategy, was lead PM, took a leave of absence in 2022, which we highlighted to you last year. That was something that we monitored, and it ultimately culminated in his retirement. Again, we've done on-sites at PIMCO, continue to meet with the team, and have no concerns given PIMCO's depth of talent across their platform. I'll pause there, as I think I've been talking for a little while here, and see if there's any questions on any of the individual managers or this report out, as I know we haven't talked about it in about a year.
Trustee Jurdy?
Yeah, so Claire, I appreciate your analysis as far as it goes, but I don't think it really addresses the underlying issue that I think we need to take to our portfolio, which is I'm not seeing in the analysis, and I realize this is the standard analysis that Callan performs for all of its client agents, so it's not customized really to us other than our specific investments. I mean, it's not, the analysis, what's being analyzed is not being customized to us. But I'm contending that right now we're measuring our U.S., for example, we're measuring our U.S. stock investment against the total stock market. And so you're looking at the total performance of a fund versus the total stock market. And that's only one measurement, the results. There's also standard deviation, the volatility of a fund. There's also maximum drawdowns. There's also maximum drawdown, or the total drawdown for the year. In other words, it shows you how quickly a fund might rebound within a year. And I don't see that kind of analysis in looking at our different funds. I'm just seeing performance against their individual benchmarks. And what I think would be more helpful for our fund analysis, and for all of Callan's clients actually, would be to look at how these things interplay with each other. So while I agree with when we get to item 8C, which is our investment policy philosophy, I have a memo for the board, and I've just sent it to staff to hopefully forward to you and Greg. Well, as I've said in previous meetings, I'm saying again in this meeting, while I agree with our statement as far as it goes, that the total stock market, it's hard to beat that in the long run with actively managed. If you're only looking at performance, I think the academic research shows that almost no one does outperform. I don't think it's true that that actively managed funds cannot roughly approximate the total stock market performance, but with reduced volatility and reduced drawdowns. And I think it's incredibly important for the performance of our portfolio if you can roughly approximate the total stock market in performance with lower volatility, with lower drawdowns, because then a portfolio can become less dependent upon low-performing bonds, which are largely in a portfolio to compensate, to ride out the volatility of the equity portion of the portfolio. And I contend that our portfolio is more dependent upon bonds than it needs to be if we instead focused on stock funds that equaled roughly equaled the total stock market portfolio, but had lower volatility, lower drawdowns, then we could effectively increase our allocation to stocks and decrease our allocation to bonds. And my memo, which I'd be happy to hand out to the board right now, even though it is for item 8C, I think it's relevant to this discussion. It shows that, and I wasn't plugging in our U.S. stock portfolio. I was simply using the total stock market index as a substitute, and I wasn't using our individual international funds. I was using the international index or our bonds. And I'll concede some points on that later. But if you look at a well-known, highly regarded, highly rated by Morningstar mutual fund of U.S. stocks, it's called the Vanguard Dividend Growth Index. I've talked about this at previous meetings. It is well known to have less volatility than the total stock market. And it does not equal, but it comes very close to approximating the performance of the total stock market. Its benchmark is at least 35 major U.S. companies, highly profitable companies. Currently, it's 42 companies. Everybody in this room will recognize almost every company on the list. It's going to be companies like Microsoft, et cetera. It has less volatility than the U.S. stock market and performs almost as well. That allows that if we were to substitute that for our stock portfolio for U.S. funds, for example, and I'm not saying it could only be that one fund, I'm just giving that as a substitute. We could have then had our bonds, we could have had less U.S. bonds. And I'm showing as an example a placeholder. The very well-known Wellesley by Vanguard actively managed bond fund is all investment-grade bonds, some U.S. Treasuries, but it's 40% U.S. stocks, again, large cap, dividend-yielding stocks, and like I said, U.S. 60% U.S. grade investment-grade bonds and U.S. Treasuries. That would have, just substituting those two with our portfolio as a sample, we would have outperformed our portfolio by about 68 basis points over the last 28 years. For every $100 million invested, that's an extra $61 million in return over a 20-year period. So, and going back to our Dodge and Cox and our bond portfolio, which I know is not the U.S. index, we're not using the Vanguard Total Bond Index. And I agree that when you plug in the numbers, they did outperform, those two bond funds did outperform the benchmark, which I used the benchmark. But they barely beat it. I mean, it's almost budget dust to go from 1.6 something to 2.1. It doesn't help our portfolio. It's still hurting our portfolio to have those bonds in there. The Wellesley fund, because it's 40% investment or dividend yielding stocks and 60% bonds, it yielded 5.5% versus 2.11. So it yielded so that 21% of our portfolio would have had an extra 3.4% or 340 basis points of return over the last 10 years. That's significant. If 21% of our portfolio had an extra 30 or 340 basis points in return, that would have moved the needle on our portfolio. And that's my point, is I don't think we have to shoot for the stars with our stock investments. We don't need to go invest in Tesla or, specifically go find and hunt, the greatest and latest tech company to go invest in. I'm not proposing that at all. I'm actually proposing the opposite. We go for a slightly more conservative portfolio on our bonds or on stocks so that we can have more stocks and have fewer bonds. And we can achieve the same volatility in our total portfolio. We can achieve the same drawdowns that we've been achieving with this mix that we have now, but we would outperform on a total portfolio basis because we would have more safe stocks and fewer low-performing bonds. And so again, I think your analysis tells us something about the relative performance of these managers related to the particulars of their indices that they're comparing themselves to. But I don't think it tells us enough of what we need to know about our total portfolio. There's nothing magical about having 21 or 22% of your portfolio in bonds. Sonoma County's going down to 15% and will probably go below that. It's all about how does the total portfolio interact with each other. And it's very clear to me that if we focused on mutual funds in our stock portfolio that had lower volatility, lower drawdowns, but roughly approximated the stock market, we could have more stocks and have fewer bonds, and we would have a total portfolio that would perform the same in volatility and drawdowns, but we would have a greater performance overall.
Thank you. Our financial investment officer, Mr. Ravelis, has some comments, I believe.
So I just want to bring to the board's attention that we're on the performance update. This is a discussion that we will have once we get there. So Trustee Jurdy, we've talked a number of times about this, but that's item 8C, and we're doing a quarterly performance update right now.
Yeah, I just don't want Callan to be left out of this, because I think there's, as I said, I think their analysis is somewhat helpful, but I don't think it addresses the underlying issue of our portfolio, and I want them to hear my concerns about the analysis that they're providing for our portfolio.
There is standard deviation measurements in the full performance report as well. So now that's just manager specific. That's not necessarily for the total domestic equity allocation. That would be more related to my memo, which we can talk about right after this.
Executive Director Rentschler.
I just wanted to mention that one of the next area of presentation is a domestic equity review. Both Mr. Ravelis and the Callan representatives have a presentation discussing about the equity components making up our equity allocation, and that might address some of the questions raised.
Thank you. Claire and Greg, do you have any other comments regarding anything that's been discussed at this point?
I'll just echo what Robert said, and I don't want the board members, let alone the newer members, to think that we don't look at drawdown risk or standard deviation or other very basic economic metrics. We have a full performance report that is available to the board and the staff, and we'd always be glad to walk through that. But Claire took 45 minutes to walk through a performance review for you. If we put in everything we know into a presentation, it just would take, more time than you're generally willing to give. So rest assured, we have a lot of analytics that support our opinions, and we do provide them to you in a full performance report. Additionally, when we did our asset allocation review, which we just wrapped up, there was pretty significant modeling in there as well, and looking at the total portfolio drawdown and the interaction of different broad asset classes to each other. I think that's probably the much more important measure of risk than picking out an individual fund. That's a second or third order exposure. The last thing, maybe Robert, I'll ask you to flip back to slide 12. I don't want people to have the impression that you're overweight fixed income, because when you look at the average public fund out there, you actually hold less bonds than the average public fund out there. Now, you could cherry pick one plan or the other and say you're more or less. The 90th percentile public fund has 15% bonds. The median has 22.5, and you have 21. So you are not overweight fixed income, and if anything, you don't have a lot of fixed income, in my opinion. We have funded some other diversifying asset classes over fixed income, including real estate and infrastructure. And I think that gives you more diversification, more different sources of returns than fiddling with your equity portfolio. Any other questions or comments about that? I mean, we do have a whole section about domestic equity coming up.
Trustee Cavanagh.
This is not a question for Callan. I would appreciate it if your volume could be raised a tiny bit. You're kind of, would like to hear you a little better.
Okay, that's me for Callan?
Both of,
Okay.
I think they're working on changing the settings. My only question regards to the information that Trustee Jurdy just disseminated would be for our council. Obviously, this memorandum was not included in the documents that were published for public review on Friday, so it's more of a protocol question of handling that and receiving that memorandum that was distributed today.
So it's fine to accept that document, and
Okay.
there's no concerns with that.
Okay. Thank you.
I have forwarded that document on to Greg and Claire.
Thank you. I appreciate it. Greg, Claire, you can proceed when ready.
Okay, thank you. And I'll try to be a little louder. First, apologies we're not there in person today. I was supposed to be traveling, but I ended up being grounded. My daughter and we went to a Taylor Swift concert, and we brought back COVID along with great memories of Taylor Swift. So we're all sitting at home today, and kind of goes to show that, you know, that whole era isn't over yet, sadly. But we're going to flip ahead, if you don't mind, to slide 28, Robert. And we put together a presentation on the domestic equity portfolio. And the purpose is to show you why we do what we do. Why do we structure it this way? And there's a lot of history and thought and research behind it. We'll also show you a few different options you could consider. There seems to be an interest in considering what we would call low vol equity. So we do have an option for that. But we'll get to that after we talk about why you currently do what you do. Now, a few of the key, so first, if we move to the next slide, Robert. We have a few major building blocks we invest in, the big categories of investments. And each of these asset classes have a purpose. They are here to do something for us. Broad equity is meant for growth. We are looking for economic growth, exposure to that. And that equity exposure has that purpose. Now, in addition to that, we have other diversifying asset classes. Fixed income lowers the risk of your portfolio very well. And we have things like real estate and infrastructure, which also provide a little bit of an inflation hedge from time to time and are driven by other economic factors than just the equity market. So when we look at deciding how much money to have in each asset class and how we manage within an asset class, we often want to anchor ourselves in, okay, what are we trying to get out of this asset class, right? So that is important to us. On the next slide, Robert. So within equity structure, what are the main factors that drive return? So the first is capitalization, whether you're owning big companies or small companies. Style, whether it's a growth or value or core-oriented portfolio. And where you spend active risk, where you choose to take a bet against the market. So those are a few big things that really drive your equity allocation. Now, we have a point of view that the US equity market is largely efficient. And if you deviate from it, you're taking a bet that it's not. So if you do deviate from it, you have to have a bunch of history that shows that category of investing should beat the broad market over the long run. And I say category of investing because from time to time, individual stocks or individual fund managers might deviate, but you want to know what is the category of those managers and are they going to beat the market over the long run? So within the domestic equity portfolio, we really have a couple tilts, if you will. The first is that we are passively invested in large cap. And that's a change. We decided a few years ago that spending active risk in large cap was not a good place to spend active risk. So we eliminated a couple active managers and an equal weighted equity index. Right? So we made that decision a few years ago. The other tilt we have is we have active small and mid cap managers because we believe that part of the market is less efficient. But I will note it's becoming more and more efficient over time. And we're a little bit overweight small cap relative to the broad market. Okay. So if we flip ahead to slide 33, here is where we're showing you what the equity portfolio looks like. Okay. So a few different cuts of the way we look at it. It's 70% passive and 30% active. It's 70% large cap, 30% small and mid cap. And it's 70% core, not taking a bet, growth versus value. And then we have about 15% spread between growth and value managers. Okay. Now on the bottom of the chart, we show the actual equity managers. And a couple of things I'll point out is, so we have 4 active small and mid cap managers, and they represent 7.5% of the domestic equity portfolio each. But they're only 2.7% of the total portfolio. I think this is important because if we swap one of these or out, we want to optimize the portfolio, right? We want the domestic equity portfolio to do the best it can, but it's pretty small at the total portfolio level, 2 to 3%. The big thing you're in is the US large cap index fund. That's the big thing you're in. That's 26% of your total assets and 70% of the domestic equity portfolio. If you want to move the needle, you change that. I don't think you should, because I think it'd be a bet against the US economy and a bet against the US equity market. So how has performance been? That's on the next slide. So the blue dot is net of fee performance for the domestic equity composite over time. The triangle is the broad US market, the Russell 3000. And then the distribution are how are other domestic equity portfolios for other public funds, other funds like you. And you see that the blue dot, hey, it looks pretty good against the green triangle. But more importantly, it looks pretty good against the peer group. So other plans didn't have as much in passive, thought they could do something better or different, and some of them have meaningfully lagged your individual performance. Okay. So performance has been pretty good overall. Next slide is the domestic equity market. So kind of the big takeaway here is, okay, Greg, we have 70% in US large cap. Is that a lot or a little? And the answer is it's a little bit more, or I'm sorry, a little bit less than the broad market. So we're invested in the S&P 500 index fund. I need my reading glasses. The S&P 500 represents about 85% of the total stock market. So we take a little bit out of the US large cap and we put it in the small cap portfolio. But it's a total of 15% of the domestic equity allocation where we do that. Okay. A graphical representation of that is on the next slide, where we have a few pie charts that show, okay, far right, this is the Russell 3000. Okay, and then your portfolio is on the left. So they're more similar than different, right? But we do have a little bit more in small cap. So why do we do that? That's on the next slide. What this is showing is rolling 10-year returns for small cap versus large cap. And it's going back a long ways. And you'll see the dotted line there. That's the average. So if you're a super long-term investor, you can assume that you're going to have a premium for investing in small cap stocks. And that makes sense because they offer a little more risk. And if you believe markets are efficient, if something has a little bit more risk, it should provide you a little bit more return. To think that something can provide you the same return for lower risk is to argue against the market being efficient. So over the long run, small cap here has shown a premium in that dotted line. Now, from time to time, it works, and from time to time, it doesn't. But if you have a 20, 30-year time horizon like this investment program, I'm willing to take that bet that it's going to work over that time horizon. The next slide shows how the active managers have done in aggregate versus the broad benchmark. And you'll see that since we made some changes a few years ago, the portfolio has outperformed in aggregate. But we do have a history of, when we had active large cap.
Greg, I believe we lost your audio.
Hear me? I'm sorry.
You're back now. Thank you.
Okay. Apologies.
You cut out at when we have a history of when we had active large cap.
Oh, right. And some of the active large cap managers underperformed. And we decided we don't want to spend active risk there. So we moved on and we put the assets in the large cap fund. So we did try that in the past. Okay. So looking at a traditional style map, growth, value, large cap, small cap, that's the next slide. And you'll see the domestic equity structures, the blue dot. The Russell 3 is that's our benchmark, right? That's the orange dot. And you see that we're pretty tightly contained right around that. So from these risk factors, we're not taking a huge factor risk. We're not taking a huge bet against the market. It's risk-controlled way of investing in the domestic equity market. Now, some of our individual pieces look different, right? But if you roll the whole thing up, our little circle there, the blue, looks a lot like the orange. So we're kind of a risk control approach in domestic equity program. Without doubt, from time to time, these styles come in and out of favor. Value versus growth, mid cap versus small cap versus large cap. It comes in and out of favor. So, and it's impossible to predict when they're going to be in favor, when they're going to be out of favor. We don't think you can time the market that way. So we want to keep an overall style neutral position to the broad market because we don't think you can time it. The next couple slides show how long these different style time periods can come in and out of favor, right? So this is a rolling 1-year return of growth stocks versus value stocks. Claire was talking about the Magnificent Seven recently earlier, and yeah, growth stocks have been leading the market of late. So you see the blue line is exceeding the yellow line at this time. And from time to time, the deviations are pretty meaningful. The next slide shows it on a roll.
We lost your audio again, I believe.
Greg, maybe try hiding your video and the audio will get a better connection.
Can you guys hear me now?
Yeah, we got you.
All right, sorry about that. So one of the important things about this is these style trends can last a while. And the thing I worry about in changing a portfolio is if something goes out of favor, it can be out of favor for 3, 4, 5 years. And will you capitulate on that trade before it pays off? So any bet you make against the market, you have to be willing to hold on to it in a governance environment and looking at performance. You have to be willing to hold on to it long enough for it to pay off. So just keep in mind, some of these cycles take a long time. Now, the next slide shows, okay, do we have any bets against the market in terms of sectors, whether it's technology, healthcare, financials, consumer discretionary? And your portfolios on the far left, the S&P 500, Russell 3 are on the right. To me, the big shout out here is that you don't have a big bet from a sector perspective, industry perspective. You're saying that the market is efficiently allocating between these capital sources. So you're not taking a big bet against it, which makes sense to us. Now, from individual sectors and industries on the next slide, they too can come in and out of favor from time to time. So we're looking at a number of the larger sectors here and looking at on the top return, the bottom standard deviation. The return one is kind of muddled, it's jumbled along, but what's interesting to me at the bottom in the rolling standard deviation, every once in a while there's a big outlier and the color changes, right? It's a different color blowing out for some reason because there's a legal, regulatory, macroeconomic environment that's affecting individual sectors. So the historic volatility of the financials, no one would have ever thought, like financials used to be low vol equity, right? They were the high dividend paying, low volatile investments pre-global financial crisis. Okay, technology used to always be why bet against Apple, right? These things change over time, so we want to stay humble in predicting that the past is going to continue to replicate in the future. Okay, so let's flip ahead and point to 2 slides, Robert. So here's our investment beliefs. One more slide. So we took this from your investment belief statement. So everything we do, we want to make sure it lines up with your stated investment beliefs, right? So this is in your written policy statement, and it is kind of making a lot of the arguments that we've been making, is that the US equity markets are largely efficient, and you want to spend active risk in areas where you think you're going to make money net of fees. So the next slide, okay, so what asset categories line up with that investment statement? Well, you'll see you get bigger bang for your buck in the smaller cap space. That's where there's less efficiency. That's where we think you should spend your active risk. Mid cap, now Claire and I were looking at this, we're like, wow, mid cap's not looking really great right now. And part of that's a little endpoint dependent. There's a little company called Tesla, which used to be a mid cap stock. And it ripped through the index. And if you didn't hold it, you were terribly struggling in performance wise. But, you know, mid cap is becoming more efficient than small cap, more efficient over time. So it is harder now. So if you pick a mid cap managers, you have to believe you're picking an above average manager on a net fee basis. Next slide. Okay, how have our mid cap managers done? So that's the blue dot here. And you see in aggregate, the blue dot is actually exceeding the index. So our mid cap managers have actually done okay for us. They've done right by us. We haven't loved them at every minute all the way through, but in aggregate, it's worked okay for us. The small cap portfolio, over the long run, it's done well, but certainly over the last year, it has struggled. And part of that is the sell-off in the growth area market, and some of our previous managers, AB in particular, has not done as well over the last 12 months. But longer term numbers, yeah, they look okay. Okay. So in summary, next slide. So the overall structure remains sound. We still think it makes sense. We made a few changes to it a few years ago. It's simple but diversified. We have limited overlap. We're spending active risk where we want, and we're balanced, and we're not taking a big bet against the market. And performance has been okay. Okay, so overall, we think what we have is pretty good. But we're open to considering other things. And so we do have a couple options that we could evaluate. And that's what the next section is about. All righty. So this is a little bit of a history of what we used to have. So that the items in red is, funds we used to have over time. So we got rid of Harbor, Boston Partners, and the equal weighted index. So that's something we did a couple years ago. And we did it because we wanted to spend active risk in the right spots, and to not try to make a big bet against the market. So you see that domestic MSRA, domestic equity, red circle? Like, we used to be all over the place. That, the risk control was not there, right? In terms of, okay, we're trying to beat the Russell 3000 index. Okay, let's hone in a little bit more and beat that index. Okay. So going forward, on the next slide, there are a couple options that we're taking a look at. One is to introduce what we would call low vol equity or defensive equity. And then the other is to replace our small and mid cap managers with SMID cap managers. Okay, so, okay, we've got 4 managers that invest in, individual silos, a small, mid, value growth. Well, maybe we should just have a couple SMID managers that do it for us, right? We could simplify it even more. And I'll note that, 3 years ago, we actually looked at low vol equity. We did a big education section on it, and we said, okay, here's something that some of your peers are doing. You can consider it. We weren't, advocating for it, but it was something that we did take a look at 2 to 3 years ago. So why would you invest in defensive equity? Well, first of all, there are a few different definitions about what this is, right? Some defensive equity strategies actually invest in bonds and call themselves a stock portfolio. So when you're analyzing some portfolios, you just got to make sure that they're not actually a balanced fund that have stocks and bonds. Some of them define it by overweighting stocks of low volatility or overweighting low beta. Some look at correlation. So there are a lot of different ways different practitioners define defensive equities or low vol equity. There is like one index out there that we use to say, okay, well, what does this category look like? All right, they're individual managers, and individual managers there's always survivorship bias with that. The ones that don't do well don't print their track record anymore. But so what's the category look like? US MinVol, MSCI has an index that looks at it. So what does that index look like? So that's on the next slide here. And you'll see that this MinVol index underweights tech growth, overweights financials. I'm sorry, it currently underweights financials, right? Overweights staples and utilities and healthcare. So looks like dividend-oriented stuff, but it looks like that sort of thing. So that's what the MinVol index looks like. Okay, has it worked? Let's look at the next slide. So here we're looking at defensive equities in declining markets, so down markets. So yeah, universally across the board, the drawdown risk is less in this MinVol index. But one thing I point out is how long are each of these time periods? They're all pretty short, right? So it's the sort of thing that when it happens, you kind of like it, but you only like it for between 1 and 4 quarters on average. Okay, and that's because the stock market tends to go up. There tends to be growth. Okay, how about in a rising market? Well, not surprising. The red bars are below the green bars in a rising market. Excuse me. How long do these periods last? They can last for years. So can you hold on to this strategy if you're wrong for 4 years? And that's the hard part. That's the really hard part. And what about cumulative returns? That's in 2 slides. And the hard part is right now. So if we had put in low vol equity 2.5 years ago, we'd be 30% behind the index.
So, Greg, I think that only is true if we had the exact same percentage in equities. And my point is, if you have lower volatility equities, you can have more money in equities and less money in low-performing bonds.
Well, I'd say bonds now have a 2-year yields are 5%, right? You don't have to take a lot of risk and you get paid money. So I kind of feel like that's the battle from, the low interest rate environment from a few years ago. And I also don't think you have a low allocation to bonds. You have 20% bonds. It's not a lot. So I would be cautious to reduce your fixed income allocation even more. So that's the cumulative returns. And then defensive equities. Okay, what sort of tracking error risk, that's the next slide, are we taking versus large cap core? It's a pretty good amount of volatility. So this kind of speaks to the level of risk you're taking versus the index, right? If you invest in low vol equity. So you're going to underperform or outperform by a full 8 to 10 percentage points from time to time. And the question is, okay, can we withstand that level of deviation and volatility relative to the broad market? Okay, so here's some structures that we put together for you. Yep, thank you, Robert. So here's some things you could consider. So the current, we think that's what you're doing is fine. We think what you're doing is good. But you could consider, well, maybe we should look at this low vol equity thing and take money out of the US large cap index fund and put it in a low vol equity manager. And to really move the needle, if you want to do this, you've got to put a meaningful amount of money in it. So a quarter of your domestic equity portfolio. So that is an alternative we could consider and bring back more specific alternatives there. Or alternatively, here's an alternative too, where we just simplify the portfolio even more. And we say, okay, let's get rid of our small and mid cap managers and just hire SMID managers. And that's certainly an option we could consider as well. So with that, that's kind of like where we thought we'd end here and just see what everyone's reactions are to see if there's an interest in making a change or and see the will of the board here. So I'll stop and listen to comments.
I'm not seeing any comments from trustees at this time, Greg. Trustee Harris?
I just want to thank you, Greg and Claire, for taking my plaintiff's suggestion of several months ago and showing us considerably more black than red for a change.
Well, that's all Claire's doing.
I believe up next we'll have the monthly investment performance and then move into the education for domestic equity risk review. So it might be appropriate, Mr. Reveles.
Well, really, this is the main investment review here.
Okay.
My document was really more of a supplement. So my document sort of could show an alternative option 3 here. Which would be what, just to satisfy the board here, let me throw this up on the screen. As stated in the memo, this is really meant to be a supplement to Callan's report. And here's some examples of some historical data swapping out one manager. So if we were to look at another alternative investment structure and swap out one of our smaller mid-cap managers, these are the types of changes we might expect to see. So the top left one here shows where our portfolio is at today. And again, the exact numbers, the 10.69% expected return versus the 17.91 standard deviation, those are not necessarily the point of this. The point of these graphs is to show the sort of change we might expect if we were to swap out any given manager. In this case, the same manager swapped out every time. So if we make one change, we can see that this orange dot moves a little bit to the left, a little bit higher up. We could see another portfolio here where this orange dot's moving to the left a little bit higher up. And that means we're lowering our risk, we're increasing our return. Now, you can see the blue dots there. The blue dots are really randomly generating different weights for the entire domestic equity portfolio. So as those blue dots, that blue blob kind of moves around, in a perfect world, we want to see it move to the left and up so that we have higher return and lower volatility. But you can see on this page that we're at around 10.7% return, and the highest return that we would be getting if we kept our weights exactly as they are today would be basically 11%. So almost a 30 basis point increase in return, making that change. The other portfolios show similar sort of activity. In this instance, two of the portfolios here, Alt 5 and Alt 6, shift the risk a little bit to the right. They're a little more risky, and for the most part, they're slightly lower return.
Can I ask a question, Robert?
Yeah.
So in each alternative 1, 2, and 3, you've swapped out a different one of our four
The same one manager, yeah. In all of these, the same exact manager has been swapped out.
But you've substituted a different
Yes.
fund in its place. Is that the
Yes,
difference?
Yes,
Okay.
yes, yeah.
So you've taken the lowest performing, most volatile of our funds, I'm guessing, and you've swapped in 3 different alternative funds in its place.
Multiple, yes. 3,
Okay.
4, 5, 6. So there's 6 different options, yeah. Again, this is just to illustrate that instead of adding low beta or completely moving away from our small and mid cap tilt, we could potentially consider swapping out one manager or 2 managers. This is an example of one manager swap here. The point is that the overall expected return doesn't change a whole lot. Yes, there is a change in any given year, maybe 30 basis points, and over time that can compound. But if trustees are expecting that we're going to make a 100, 150 basis point leap, that's unrealistic. And Greg sort of alluded to that on one of his slides, where he talked about the total allocation is less than 3% for each one of our small and mid-cap managers. So we'd have to move a meaningful amount to have a overall portfolio effect, that's significant. So I would say there is maybe an Alt 3. We could look at changing any given manager within our current structure. We don't necessarily have to just change the structure.
So what if, to me, reducing the standard deviation of our U.S. domestic equities from almost 18% to about 15.5% is a substantial achievement, even if it did not increase our performance. But you're saying in this example, we could achieve that reduction in volatility, which I think is substantial, and achieve a small, modest increase in the performance of the U.S. domestic equities. So I think alternate 3 is like a no-brainer. It looks like we've got a bit of a dud that needs to come out and something else in its place. Now, I'd be curious from some additional scenarios where Greg and Claire talked about the possibility of going to 2 active managed funds instead of 4, what would happen if we looked at something like this fund, maybe taking out our 2 lowest performing funds or 3 lowest performing funds that are actively managed, and just swapping in 1 or 2 that you found would be better? I'm just kind of curious. You've taken a very incremental approach and said, okay, we have 7.5% of our U.S. domestic equities in each of these 4 actively managed funds. This is what you get if you swap out 7.5% one of those funds. But what happens if you up the ante and go, okay, we're going to take out the 2 low performing and add in this 3rd, or add in this 1 and pull out the 3 lowest performing? I mean, the changes would be even more dramatic, I would guess.
Yes, but at a certain point, depending on how you want to allocate your funds, all of your money ends up going into 1 or 2 best performing strategies. Callan's approach here with the 4 actives kind of spreads that active risk out. We certainly could look at that. We certainly could do that if that was the board's direction.
Well, again, my point is, if we reduce the volatility of these funds, we could have more money in stocks and less money in bonds. So I'm interested in knowing how we could reduce the volatility of our equities.
Does the board have any thoughts on swapping out 1 or 2 managers and kind of looking at that, or?
I think we're looking for some direction to staff here of something that Robert and Callan can present, different alternatives potentially to come back for consideration. Am I wrong? That'd be appropriate direction here if anyone has some. Trustee Harris.
I apologize, but I have a doctor's appointment in Rohnert Park at 11:30, so I need to leave. But I certainly am not in favor of making any moves that we haven't totally studied. I've been very happy with our performance. Yes, there are places we could do better, but I would not be in favor of making any kind of a decision today on swapping out funds. I think that's something that we have Callan as our investment group that we have hired to give us their best input. I do think we can continue to look at things, and I'd like to be in on the next step as far as whether it's staff direction or whatever, but I'm not in favor of a quick move, period.
Understood. Thank you. Executive Director Rentschler.
Thank you, Chair Cromer. And to address Trustee Harris's comments, we would not be looking at a motion or direction from the board as far as actually modifying our investments or our portfolio allocations at this time. But if it's the will of the board, we can certainly ask Callan to bring back some firms to replace perhaps a manager or 2 in our portfolio, and look at, have them do sort of a manager search and come back with a short list to talk to us about what would be entailed and the impact of doing something like that, if that's the direction the board wants to go.
Well, so can I say one more thing? To me, the significant decision here, I guess, is low vol. Is the board interested in having a low volatility strategy added to the portfolio, given what we have heard from Greg?
Is there any input regarding the new low volatility? That would be alternate 1 on page 61 of the Callan report.
So no, I hear no.
Yeah.
I personally am more interested in what you and I believe Trustee Jurdy were referring to is identifying some of our underperforming and proposing alternative comparisons with other managers. That's what I'm more interested in seeing. And I don't think that's reflected on Callan's page 61, other than alternative 2, which would be moving away from mid and small into this SMID group, SMID cap, which sounds interesting as well, but I'm more interested in the underperforming ones and the alternatives to those, personally.
Yeah, alternative
So-
2 is really tilting away from the small cap. You know, as Callan's shown, over the last decade, small cap has underperformed. But going back to that sort of idea, there's this notion of mean reverting, which I do believe in. And when one thing is out of favor versus its long-term average for a decade, you know, there could be some bounce back. So that would be the one point that I would make with regard to moving out of, tilting away from small cap active management.
You know, a lot of times the way we think about this on this slide is, let's pick the categories we want to invest in. And then we hire and fire managers within those categories. So Claire went through her analysis and came to the conclusion that overall, we think your individual managers in your current categories are living up to expectations. So we think they're doing okay, and we think your current categories you invest in are appropriate as well. So I kind of want to, you know, this is consultant speak. I totally get it, right? That, you know, we kind of think about these in steps. The first is broad asset allocation decision. You already decided how much you want in stocks and bonds. It was approved and is codified in your policy statement. Check, right? We just did that. Okay, next thing, how do we implement within each asset category? That's what this slide is. What buckets do we invest in? I think your buckets are good. You know, the way you're structured. Yeah, we could do things differently, but that's a structured decision. Third thing, okay, do I have the right managers in each bucket? That's a third topic, different question, right? And we report that third thing out to you every quarter when we meet with you. So don't feel like you have to make that decision today, right? Do I swap out the Fidelity low price stock fund, right? You don't have to make that decision today. Every time we meet with you, every quarter, we say, hey, they are not living up to expectations. Let's do a search for a mid-cap value bucket. So that's the way I would think about it. 3 distinct decisions. Already made asset allocation decision. Today, we're talking about the manager structure, buckets. We can always talk about the individual managers to the extent we feel like they're not living up to expectations.
Is there any other direction that trustees would like to provide to Callan or Robert?
So I'm looking for clarification. What are we giving direction to Robert to do? To me, I would definitely support having Robert continue to look at our portfolio with Callan. And I'm intrigued. I have no idea what this alternate 3 fund is. I don't know which of the 4 is being swapped out or which is his alternate 3 swap in. I'm guessing it could be a small cap because he made a defense for small cap. I do know that in general, it's really difficult to find small cap funds that are not highly volatile. It's easier to find large cap and even mid cap that are less volatile than small cap, but there may be 1 or 2 out there. Maybe Robert's found a small cap that's low volatility and yet still performs well. Maybe he's found the rainbow or pot of gold at the end of the rainbow there. But I'd like to see some additional analysis and some alternatives. I think from my looking at our 4 funds, that 3 of our 4 are more volatile than the S&P 500 or the total stock market. So I'd be interested in looking at all 4 of our funds. The only one that's not more volatile than the S&P 500 is the Fidelity low price stock fund, but currently in the more recent years it hasn't been performing as well as the S&P 500. So it's been underperforming, but at least it's not more volatile.
The one thing I'd like to point out is the S&P 500 is not their benchmark. We are not hiring them to produce a volatility return perspective relative to large cap stocks. They're managing portfolios relative to small and mid cap stocks, which by their nature are more volatile and have a higher standard deviation. That's why we hire them. That's what they're charged with doing.
So I know, Greg, we haven't asked for a fund that's no more volatile than the S&P 500. That doesn't mean this board can't be looking for funds that are no more volatile than the S&P 500. I know it's very rare to find such a fund, but that doesn't mean that such a fund doesn't exist.
Well, yeah, and that's what the Minvol equity allocation would be, right? That 25% that we put on the page here. But what I'm saying is that the Fidelity Low Price Stock Fund, the Prudential Small Cap Value Fund, their relevant metric of whether or not they're doing a good job or bad job is not the volatility relative to the large cap index. It's the volatility relative to their respective indices, which is, small cap stocks.
So that's the standard the industry has placed on itself. I'm saying as a trustee of a portfolio, I'm saying that a benchmark that I would like us to see measure against these funds is in fact the volatility of the S&P 500. It's not that we're going to find funds that always have a lower standard deviation and lower drawdowns than the S&P 500, but I still think it's a benchmark we should be attempting to achieve.
Yeah, and your total portfolio, your total equity portfolio is benchmarked to the Russell 3000, which is large cap and small cap, right?
So for clarification, the direction I'm soliciting input on is, it doesn't sound like any of the trustees are interested in hearing more information or studies on alternative 1. I have not heard a single reference to that or any interest in it. Obviously, the current one can be dissected and reanalyzed with other stocks and equity managers. And so is there any interest in alternative 2 with this mid cap, to have that compared to the current ones, with then us determining later the managers, as Greg put the 3 steps?
Well, I'd like to see alternate 3 that Robert's come up with, but I'm also intrigued by the alternate 2 because it could be that what Robert's working on could fold potentially into alternate 2. I mean, we could potentially pare down the number of active managers from 4 to 2. I wouldn't want to rule that out, I guess, at this point.
I personally was considering Robert's alternative 3 as a later step to then determine the managers and to change the percentages, but
So that's really the second step that Greg was talking about, is structure. Are we okay with the small cap tilt? Or do we want to move up the cap structure to be more mid cap, maybe a little bit of small cap, but less active? There's good strategies and good managers in every cap. So we can always look at good strategies, long-term management teams, highly performing products. It's just a question of, does the board want to move away from small cap or not?
Trustee Covison?
Thank you. I think we need to see a little bit more information and have more time to consider the question.
Right,
Okay.
we're asking for direction from the board on what you would like us to bring. Would you like us to bring back more information on the alternative 2, which moves us from specific managers in small cap and mid cap into managers using a SMID cap, which essentially moves the portfolio away from a small cap tilt or Robert, do you have anything to add to that?
I understand that. I think we're talking 2 or 3, 2 and or 3. I mean, I don't think you're going to get specific direction to only do 2 or only do 3.
Well, alternative 3 is not really an alternative being placed necessarily for the board. That was an example of keeping our current allocation as in the portfolio, and then looking at maybe switching out a particular manager or two. If that's something the board wants to look at, that's fine, but the first thing we have to know is whether or not you're happy with the current allocation, or if you would like more information on alternative 1 or alternative 2, as far as changing the broad categories that we invest in before we get down to the manager level.
I personally would like to compare the current to alternative 2, and if that's the only direction you're going to get, then I will give it to you.
So that's 2 at least.
Why, there doesn't seem to be a conflict between alternative 1 and alternative 2. I'm wondering why they're even broken out as different alternatives. You can do both at the same time, and I'd like to see alternative 3 lined
You
up.
mean current? Do you mean current? Alternative 1 has the low vol. That is a significant.
I think he's asking for an alternative that includes low vol and a switch to SMID. Is that correct, Alex?
Yes, because I don't really see a conflict between those two concepts. What, am I missing something? For instance, you can consolidate to using the SMID value, the SMID mid-cap strategy, and also add the new low volatility there. Why are they, I guess I don't understand why they're broken out into two separate.
Now, that would be a question for Kellen. Certainly, there could be another alternative that includes low vol and a tilt away from the small cap. So it would be like alternative 2, but with a low volatility. That's another option. I don't necessarily know why Kellen didn't present that. Maybe Greg, maybe can you comment on that and help us understand that?
Well, we were looking at different philosophical paradigms here. Like, what are you trying to do? And again, at the end of the day, Callan thinks what you have now is fine. It's good. It's worked well for us. We wouldn't introduce low vol. That's alt 1. And we would only move to alt 2 if you were unhappy with your existing small and mid-cap managers. I don't think you are unhappy with your existing smaller mid-cap managers, but that would be the only reason to move to alt 2.
From my perspective, it seems like most of the trustee interest is in potentially staying with the current and pursuing other managers or analyzing other managers.
Yeah. Okay.
That's what I've heard, which would be the next step once we decide on the asset allocation within this asset class.
How about this, if you don't mind? How about next meeting, we come back and we do a deep dive on each of the 4 managers, and then we'll say, okay, actually, we're not happy with XYZ manager. Maybe we should do a search for that bucket.
I like that, and that will help us consider different alternative managers if that's the desire of the board.
Yeah, because right now, if we go look for a manager, we don't know in what bucket, right? So that might provide us a little more direction.
Let's go with that. Thank you.
So just to clarify, to make sure I'm on the right page, it's to stay with the current allocation and have Callan come back and potentially pursue a manager search to replace specific manager.
Or simplify the 4. I
Okay.
think that's an option as well. To reduce from 4 to 3 or 2, I think is something that Trustee Jurdy has referenced if they're underperforming.
Okay.
So not just to stick with the 4, don't be beholden to that, but to consider different alternatives within that.
Yep. Okay, we can do that.
Trustee Kelly?
It would be nice to keep in mind these long-term swings on some of the other graphs. And if we're considering changing manager A to manager B, it would be nice to see if it's a systemic difference in underperformance versus peers or by point in time difference. looking at, 1 quarter versus 10 years is a whole bunch of difference in each of these classes as well as manager by manager, unless there is a significant difference over time with a trend towards under or outperformance, one manager over another. But looking at quarter by quarter or a specific time period is not so good as this over time relationship.
Do you have any public comment regarding this item?
There is no public comment.
Thank you. And I believe we have one other thing that Callan's here on, is that correct? No? They have,
It was really only the monthly,
okay.
which I
I think it's a good time to take a break, number one. And number two, when we return from the break, I believe we're going to call the items that Siegel is here for, so.
Yes, at the pleasure of the
Yeah.
board. I'd like to take it slightly out of order in deference to Siegel's time here. If we could cover items 5 and 6 and then go back and pick up item 4.
Understood. So we'll be on break. It is currently 10:33, so 10:43. Thank you.
Thanks, everyone. Bye-bye.
Thank
care.
you. Thanks, Greg. Thanks, Claire.
We'll call back to order the August 16th, 2023 Board of Retirement meeting, and that leads us to item number 5, review and update regarding the transition from book value to actuarial value for maintaining reserves in the general ledger. This is being called out of order.
Yes, thank you, Chair Cromer. I just wanted to mention to the board that we actually had discussed this with you back in June of 2022 when we talked about the reserve realignments to more closely relate to our liability structure. We notified you that we would be doing that at this point in time. It will involve a new policy that actually will be coming next month, but we wanted to give you an overview of what this transition meant because it had been so long since we discussed it. So we brought in our actuaries. We have Paul Angelo and Andy Young with Siegel here. They're going to give a presentation on that transition.
Thank you. Take it away.
Okay, thank you, Mr. Chairman. Thank you, members of the board. Paul Angelo and Andy Young here from Siegel. And what we're going to be talking about here is something that used to make a big difference to people, now makes less of a difference. So if you get a sense of maybe over-explaining a little bit, it's because of this whole idea of so-called excess earnings. I'm not supposed to use that term. But here at Mendocino, Sarah, 10 years ago, there was a benefit that was funded out of, you credit interest on reserves, and if you're done crediting interest on reserves, there's anything left over, you're enabled under the statute to use that to, in fact, create new benefits. That practice is largely out of favor in California, and here in Mendocino, I believe it has not been in practice for over 10 years, I think, Andy?
If not over 15 years.
15 years. So this is really sort of a behind-the-scenes bookkeeping discussion we're having today, but it is consistent with last year. You had a couple of your reserves that were out of sync with your liabilities, so now there's a process for doing a transfer to update those. What we're talking about here is, what do the reserves add up to? And back when these systems were created, everyone invested in fixed income, and so book value was a big deal. What did I pay for it? And so the reserves were maintained at book value. Over the 40 years, 50 years, 60 years since, your funds are now, as you've been suggesting for the last hour and a half, you're now invested in a broader range of securities. You now use asset smoothing to manage volatility on the valuation side when you're determining the employer contributions and your liabilities. But your reserves historically have still been maintained on a book value basis. So what we're going to talk about is sort of synchronizing the way your reserves are maintained with the way the plan's actually being funded. So Robert, next slide. This is a classic picture of, you may have seen, if you've ever been to a calipers training, that we talk about C plus I equals B plus E. I have a little button here, C plus I equals B plus E. Contributions plus investment income equal benefit payments plus expenses. So in most public pension funds, this is all you need to know. But when you have these reserving mechanisms, Robert, next slide, this is what happens when you add in what the statute allows, which is you can take some of your investment income, and after you credit the reserves with the assumed rate, that goes down in the valuation assets, whatever's left over is called undistributed earnings. And back in the day, you would actually use that to pay ad hoc benefits. You could either pay them sort of out of pocket, or what you would actually do in practice is you would set aside some funds in an ad hoc benefit reserve. I believe that at Mendocino it was primarily for health benefits back in the day, 15 years ago. And then you would pay those ad hoc benefits out of that tank after holding back something called a contingency reserve. There's a rule in the statute that says before you can use undistributed earnings to pay ad hoc benefits, you have to have at least a 1% contingency reserve. This is an old version of asset smoothing. It's a form of volatility management. But in practice, for the last 15 years, that spigot, I don't know if you can point to it, that spigot in the upper left going to ad hoc benefits, that has been shut off. And any undistributed earnings after holding on to that contingency reserve go straight down into the valuation assets. That's been your actual practice. So what we're discussing here is not going to change employer contribution rates. It's not going to change member contribution rates. It's not going to change the benefits the member receive. It's all this sort of accounting structure. So let's go to the next one, slide 4. The way this adds up for your current reserves, and we're going to show, we have a sort of a chart to show this later, a little box. But the idea is you have a bunch of different reserves starting at the bottom left. These are what we call valuation reserves. One is where you accumulate the member contributions. One is where you accumulate the county contributions for active members. And then when someone retires, you transfer the value of that member's benefit out of the employee contribution reserves and the county contribution reserves into something called a retiree annuity reserve, a pension reserve, and a COLA reserve. All these are added together and count toward the valuation assets. Then there's this contingency reserve. That's that 1%. That's what we call a non-valuation reserve. And so then because these things all add up to the book value, then to get from there to the market value, it's simply unrealized appreciation. This means any stock that you bought for 100 and maybe now it's worth 120, so the market value is 120, book value is still 100, so that $20 of unrealized, meaning you didn't sell it to realize it, that's sitting in unrealized appreciation. So if we go to the next slide, we're going to show that again in a diagram stacked up next to the way we do valuation assets. It'll be a little bit clearer there. So number 5 here, we credit and maintain these reserves because we're required to under the 1937 County Employees Retirement Law. And there are two questions, but they're actually very interrelated. One is when you're trying to determine how much earnings you have to credit on the reserves, what counts as available earnings? How do we measure earnings? And the other is when you want these reserves to add up to some number, to match some asset number, which asset number do they match? We're going to see on the next slide, one determines the other. So this isn't really two different decisions. But again, under the structure, any remaining available earnings after you have credited interest based on whatever earnings you're using to measure earnings, whatever is left over is available, it goes into contingency reserve, or it can be extra added interest to the valuation reserve. That was that downward pipe that we saw. But it also says that you can use these remaining available earnings can be used to pay ad hoc COLAs, or in the case of Mendocino, way back retiree medical benefits. Now the next slide, slide 6. This point is a little elusive. The idea is, if you're going to say measure things at market value, you can measure, if you measure income on market value, that will get you from one market value to the next. So if you are saying we're going to use market value, you can either tell me the value you're going to use, that is your market value end of year, market value beginning of year. Then if you tell me what your contributions and benefit payments are, which are non-investment, whatever is left is going to be your income on a market value basis. So you can get the income on a market value basis if you tell me the two asset values. Or you can go the other way. If you start with this year's market value and someone calculates what are your contributions, benefit payments, and your income on a market value basis, that'll get you to your market value at the end of the year. So you can either describe the asset method by telling me what the market value is at the beginning and end of the year, or you can tell me what it was at the beginning of the year and tell me what the income is. So when we talk about measuring assets on a book value basis, it means we're also going to measure income on a book value basis. And if we're shifting to measuring assets on an actuarial or smooth value basis, then we're going to measure income on an actuarial or smooth value basis. The next two slides walk through how that works. Let's start with the asset values on the left and the earnings recognized on the right. So if you're using market value, what counts as income? Well, it's pretty much everything. It's what we call current income, that's interest, dividends, and rents. It is realized appreciation or depreciation. So when you if you bought something for 100 and you sell it for 120, then that year you're going to have $20 of realized appreciation. But as far as the market value is concerned, you don't have to sell it in order for it to show up in your market value. So going back to my example, you have a $100 stock, and it's now that you bought for 100 and it's now worth 120. If you haven't sold it yet, then that $20 of appreciation will show up in unrealized appreciation. So the market value earnings includes everything. In contrast, look at the book value earnings. It only includes the first two. It includes current income, that's money that actually comes in the door, interest, dividends, and rents, but it only recognizes appreciation when you sell the stock. So it only includes realized appreciation and depreciation. Now, neither of those are what we use to measure the employer's unfunded liability and therefore the employer contribution rates. For that, according to your policy, we use something called the actuarial value, and we use a very common version of that. It's called a 5-year smoothing. And there's another whole actuarial 101 we can do on asset smoothing, but the idea was, since we really don't, when your investment folks talk to you about income, they don't come in and say, well, you made 8.4%, and of that, this much was current income, this much was realized and realized. They look at total return. So when we do asset smoothing, it's the same idea. We take your assumed return, which is currently 6.5%. We take your total return on a market value basis, and if you earned exactly 6.5%, then we don't do anything. It goes right into the smooth return. But if instead of earning 6.5%, if you earned, do this right, 11.5%, that's 5% more, we would only recognize 1/5 of that earnings above the assumed rate in the current year and another 1/5 each the next 4 years. Now, we wrote this out here. It's 1/5, 20% of the market value gain or loss in each of the last 5 years. This is already an established part of your funding policy. When we present the actuarial report, we always show you what the returns were on a smooth basis and on a market value. So that's the earnings that's recognized. To beat this horse to death, on the next one, slide 8, this is what earnings do we not count? Well, the market value, anything that you earn shows up in the market value, so nothing is deferred. On a book value basis, remember that $20 that you earned on that $100 stock, that's not yet recognized, so that recognition is deferred. And on the actuarial value basis, well, if we recognize 1/5 of the current year gain or loss, then we're deferring 4/5. And there's a table that shows how that works each of the 4 years. So the only point is the actuarial value is what's currently used to determine your unfunded liability and your employer contribution rates. And what we're proposing is that we use that same basis for your reserving. And that will require a one-time transfer. So let's go to page 9. Currently, you're measuring available earnings on a book value basis. That's because in order to get from 1 year book value to the next year's book value, you need to use book value earnings. And so your total reserves equal book value assets. That's because if you start with book value and you add book value earnings, you get the book value at the end of the year. So if they start equal, they stay equal. In contrast, on slide 10, for the actual valuation, instead of sort of building it from the ground up with these reserves, we do it the other way. We start with the market value of assets. We do that calculation of that 1/5 of the earnings above or below the assumed rate for 5 years. We back out what we call the deferred gains and losses. That gets us to the actuarial value of assets. And then the only place where the reserves come in is there's that one reserve, that contingency reserve, which is called a non-valuation reserve, so we take that out as well. So the reserving, the only place where your reserve structure brushes up against the actual funding of the plan is in that 1% contingency reserve. That book value number that's used as a basis for reserving is not used in the actual funding of the plan at all. And so that's why we're proposing changing the reserving basis to bring it in line with the way we actually fund the plan. The next slide I hope helps a little. So this is on the left side is the reserving basis. This is what we saw before. There's the valuation reserves. There's one non-valuation reserve, which is contingency. That gets to the book value. And then whatever the unrealized appreciation is, you add that in, that would get you all the way up to the market value. On the right side is how we do the actuarial valuation, how we determine the assets that are compared to your liabilities to see what your unfunded liability is. There, we start with a market value. We apply that asset smoothing method, and whatever is being deferred under that 5-year smoothing, we take that out. That gets us to the actuarial value of assets. And then we subtract out the non-valuation reserve, which is exactly the same as the contingency reserve. Those are the same number. These are not very well drawn here. So imagine that the contingency reserve box and the non-valuation reserve box, those are exactly the same number, and that gets us to the valuation value of assets. But there's no necessary relationship between the valuation value of assets and the book value of the reserve. So the reserves add up to a number that is unrelated to the number that's actually being used to determine employer contributions. That's what our proposal will change. Now, the next 2 slides present a case of why we should stop using book value. I'm not going to go through that in great detail. The main reason is that there's no reason to continue to do so. Back when it mattered, you could actually play with the results. There are anecdotal stories of on December 31 let's use June 30th, our earnings were low. Hey, you got any realized gains that you can sort of sell real fast so they can show up in the book value so we can have more earnings to credit? That is not happening because no one cares about that number as much as they did when it could control benefits. But you can get some mismatches of when earnings is recognized by using book value of assets. That's the points that are made on 12. And so when we get to 13, what this means, though, is currently you would think that whether you have earned more or less than the assumed rate on your smooth value should correlate with whether you have more or less than you need to credit interest on your reserves. Those two numbers are now uncoordinated. Our proposal is going to make those coordinated. So on 14, we're looking at this from a sort of a policy perspective. These are all the things that we think are generally considered good policy directives. We want to have consistent recognition of market value gains and losses, both on the unfunded liability and on this interest crediting stuff. We don't want excess earnings to be impacted by trading decisions. And again, I'm describing a situation that some agency risks that no longer really apply here so much. We don't want consistency between investment gains on the valuation and on the interest crediting side. And so all of these things will be accomplished by what we're going to propose, which is in the next two slides. So on 15, so what we're going to propose is that we change the way we measure earnings. Instead of using earnings on book value, it will be earnings on an actuarial value, that 5-year smooth value. We are then going to take the valuation reserves, and we're going to basically take some of what is currently in unrealized appreciation and put that into a new valuation reserve. That's a one-time activity, and we're calling that an actuarial value transition reserve. And what that will do is then mean that your valuation reserves, when you add them up, will equal the valuation assets that we use for funding. So the picture on that is on 16. So this is the same as we had on slide 11, except now on the left side, the valuation reserves have a new one added to it, the actuarial value transition reserve. This is simply, it turns out to be the difference between the unrealized gains, which was the top of the book value stack, and the deferred market value gain loss, which is the top of the actuarial value stack. Both those numbers are available. So we take that amount, we put that into the valuation reserves with the goal that now the total of the valuation reserves equals the valuation value of assets. Even though the valuation reserves are you get them by adding up all the ones from the bottom up on the left, and that'll give you the same numbers if you start with market value, take out the asset smoothing part, what is deferred under the asset smoothing, take out that one non-valuation reserve, which is still that contingency reserve, and that gets us to the valuation value reserves. Now again, I'm making a mountain out of a molehill, perhaps. Again, in the days when there were actual retiree benefits that were funded out of these earnings measures, it was sometimes politically sensitive. You're going to change the way we measure earnings. They're going to change the way we measure undistributed earnings. They're going to change the amount of resources we have to pay ad hoc COLAs or retiree medical benefits. However, under current practice, this is, because those are no longer part of your ongoing practices, this is really just a behind-the-scenes bookkeeping adjustment. Slide 17, again, talks about the fact that by now that we have consistency in the way that we measure investment gains for funding and the way we measure so-called excess earnings, so interest crediting, that will be, it will also be true that the amount of earnings that you need in order to not have a gain or loss on the valuation side, which makes your employer costs go down or up, will be the same as the amount of earnings that you need to credit interest on the valuation reserves, because they both equal the valuation value of assets. Okay. On slide 18 just shows that there is a transition amount. It is a valuation reserve. We do that because we don't want the unfunded liability to increase. Remember, the valuation value of assets has those non-valuation reserves taken out of it. If we took this transition and made it a non-valuation reserve, I realize I'm almost in a foreign language now. If we made that a non-valuation reserve, that would actually make the valuation assets smaller, make your unfunded liability bigger, your employer contribution rates go up. We have no intention of doing that. So that will be a valuation reserve. That's why you saw that back on 16. You saw that it was in the lower left box with the other valuation reserves, the actuarial value transition reserves. This would all be done effective, Andy, check me on this. We would do these adjustments as part of the July 123 evaluation. Again, it is not going to change it's not going to change anything that involves your employer contribution rates when the valuation is presented, but it would change then the interest crediting process and stuff would have a new sort of starting point. Although in practice, this can be done at whatever date is administratively convenient for
Sorry for the confusion, although the idea is actually do this effective 7/1/2023. So that means that with the valuation that Segal will be presenting in November, we still do it the old way.
Yes.
As Paul has indicated, though, that the old way is really no different from the new way because we are not changing the underlying valuation value of assets. The assets is the same, but it's almost always desirable to true up the reserve after we complete the valuation. So that's why on the slide, we deliberately choose 7/1/2023 as opposed to June 30, 2023.
So this year's valuation will be the last time, there's a page in our report that shows the reserves. This will be the last time that is done on a book value basis. And then we'll make the change from there going forward. Now, there are other questions that will come up. We are working with staff to develop a written interest crediting policy. There are some other questions that come up there. One is this contingency reserve, this 1% of assets, that is basically being taken off the table, which means your employer contributions are larger than they would otherwise be because there's 1% of your plan assets that is sitting fallow and not used for anything. As long as you are, now this is partly a legal question, I'm looking at Jeff, as long as you are not using these undistributed earnings to do anything other than fund the statutory benefits, other systems have concluded that you do not need to continue to maintain that 1% contingency reserve. So that would be a one-time change that would take 1% of your assets, put them into the valuation, take them out of the non-valuation reserves, right? So that puts it into the valuation assets, and that would be a one-time reduction in your employer's unfunded liability, and therefore the contribution rates to fund that unfunded liability. So that would be part of what is under discussion to bring back when your staff brings you the new policy. And then the other one is there are some, now this one actually affects benefits, so everybody perk up. The interest crediting rate on the member contributions, okay, is currently set equal to your assumed, actual assumed rate, currently 6.5%.
6.75.
Soon be 6.2, yes. Yeah. It's been 6.75 up through June 30, 2023, and will be 6.5 going forward. There are systems who say, you know, the main people who benefit from that interest crediting are members who do not complete their careers with your contributing employers and then retire, but rather are what are called terminated vesteds. They quit after having the number of years needed to vest. They take their contributions and go do something else. Well, they are in effect getting a guaranteed rate of 6.75 or 6.5%, which you cannot get at your local savings and loan. At least until recently you can get closer, but for a long time, of course, savings rates were much, much lower. There are some systems that use some sort of external rate, like a T-bill rate or something, or there are also systems that simply take the assumed rate and just notch it down somewhat. So one of the things that's under consideration, discussion with staff, is whether the member interest crediting rate might be something less than the full actuarial assumed rate. And that would be a policy decision for you folks to act on. I think those are the two main open items that are not covered in the slides here. So the three things are we definitely want to move the valuation, the reserving basis from book value to actuarial value. And then we also will consider whether we still need to maintain the 1% contingency reserve, and which would affect the employer contributions, and also whether we would consider something other than the assumed rate as the member interest crediting rate, which would affect member refunds. So you got one thing that doesn't affect anything, that's that reserve change. You got one thing that could affect employer contributions, that's the 1% contingency. And you got one thing that could affect member benefits, at least members who would draw their contributions, and that's the member interest crediting rate. So I think, checking with Robert and Doris, I think those are our main three items that we wanted to, that we'll be bringing back to the board. Check me if I left anything out.
Yes, and all of those items will be addressed next month when we bring forth the policy. Since it is a new policy, we likely could do it as a first read in September and adoption in October, but those would be some policy questions. The change itself from book to actuarial, it has no change in the plan as far as our unfunded liability, our funded rate of the plan, employer contributions. None of that is changed by just the change of moving from book to actuarial value. Those other two questions about whether or not we want to maintain a contingency reserve and whether or not we want to use a lower member crediting rate, those are policy decisions that the board will make as part of the interest crediting policy that will be brought back next month.
Mr. Chairman, those are our prepared remarks.
Thank you, I appreciate that. Any comments or conversations? Trustee Jurdy.
Question then comment. So question, to just be clear on this, there's no way in which this change of the accounting of the fund, that it could in any way increase the county's contribution to the plan?
Not at all.
Okay. And then comment on the people who choose not to stay with the county for 5 years and choose not to transfer to a reciprocal agency, but, you know, take a career in a totally different direction. I think if I was unaware that we had the legal authority to credit them less than our assumed rate of return, and I would fully support crediting them less than the full rate of return, because after all, the vesting into a pension plan is a significant reward for an employee for committing at least 5 years with an agency or going to a reciprocal agency and making a career in public service. If someone dabbles in public service for less than 5 years and is not vested, that's a lot less loyalty to the public service and to the organization, and therefore I don't think, if we're not legally obligated to provide them with a guaranteed rate of return of what is still a very handsome guaranteed rate of return of 6.5%, I would say if they choose to take their money out because they did not invest with a reciprocal agency, then I would support less than that. In fact, I might peg it at whatever our bond rate of return was during the time that they were with the county.
I want to clarify one thing. It's a broader group than just that. We're talking also about members who work 5 years or more, so they become vested, but they do not continue in employment until they're eligible to retire. So there's a whole category of people in your data set that we call terminated vested members. So they did vest. They did vest. When you get your 5 years of vesting, let's say you work for 15 years and you quit at age 40, you have a choice. You can take your money out, or you can leave your money on deposit, and then you will get, when you reach retirement age, a retirement benefit based on your 15 years of service, in my example. So it's not just the people that leave with under 5 years, it's anybody who leaves before they're eligible to retire and elects to take their money out rather than leaving it in the system and thereby having a deferred vested benefit. So it is a broader group.
So for clarification, so if someone was vested with the county, they worked here for more than 5 years, or they went to a reciprocal agency and became vested in more than one agency, they choose to not collect retirement instantly. Maybe they're not 62, maybe they're not 67, and they're waiting to, would they still get or is it only if they withdraw the funds?
Only if they withdraw the funds. If they stay till retirement, their funds stay in the fund to help fund their benefit. Now, there are some situations where if you elect option 1 and you die before you receive benefits equal to your contributions, you get the balance refunded, somewhat marginal. But we're really talking about the people who never get an annuity benefit from the fund. So take their lump sum.
Are we talking about
If
5 people a decade?
If I could clarify for you, maybe this will help. All members who are working or deferred will receive the member crediting rate, even if that rate is lower. It really doesn't matter to those individuals who eventually draw a retirement benefit, because their retirement benefit is based on salary, service, and the multiplier. It has nothing to do with the dollar value of the account. So if they earned a few less dollars in interest, it doesn't affect the monthly benefit that we pay that is defined by formula in the law. So everybody, while we're working, if we're deferred, whatever, receives that lower member crediting rate. And then those people that choose to take their money out leave with a little bit less money, because overall we credited all member accounts with a lower interest rate.
So my assumption is that something like 98, 99% of the people who withdraw their money were never vested, and that it's only 1 or 2% that get vested and withdraw the money. Am I way off on that?
Well, let me give two pieces of data. One is, you've got it went up in June 30, 2021, you had 577 of these inactive vested members. Left their money on deposit, and are going to get a deferred benefit. That number actually went to 923 in 1 year, so there was some turnover there. Now, my question for Andy is, if we look at the assumptions, we generally we have a probability of quitting, then we have a separate assumption of what proportion of members who quit and are vested, what proportion leave their money on deposits and become a deferred vested versus take a withdrawal. And Andy's looking for that assumption right now. Gotta be in there somewhere.
So I'll mention two items real quick while you look that up. First of all, the large increase in the number of inactive accounts reflected on our actuarial valuation data had to do with the reestablishment of a number of accounts for the inactive interest correction as part of our VCP. So those folks are truly only going to receive a refund of the remaining interest that was credited, that corrected balance. And that's why those numbers jump back up. We had to reopen accounts for those people and give them the omitted interest. On the second point, even someone who's not vested has the legal right to leave their money here and continue to accrue interest, even though they're not going to be eligible to receive a lifetime retirement benefit from us because they don't have the requisite minimum years of service. And this would simply provide a lower interest rate to all of our members, and that means the folks who do eventually choose to take their money out, that is not a retirement benefit but a lump sum distribution, would receive a smaller lump sum distribution than under a policy that uses the actuarial assumed rate of return for crediting interest.
And maybe Andy's going to answer this question, but my assumption is nearly everybody who withdraws their money is not vested. And that almost nobody would be stupid enough to take their money out if they were vested. Or do we have some people in that latter category?
I'll agree with you that it's pretty stupid, but so for people with less than 5 years of service, 85% of them take their money out. 15% of them leave their money in. For members with over 5 years of service, they are vested, 25% take their money out. 75% leave their money in. So it does reverse, but it's not none. 25%, you show them a pot of money and they take it even though they're forfeiting the entire employer-funded benefit. Don't get me started, but yeah.
Trustee Land.
Yeah, I was wondering if this would be applied to current members, or would it just be people who are joining the plan moving forward?
Everyone.
Everyone.
Everyone? Yep. What about people who are vested? Would you see a decrease in your balance?
No,
backwards?
I think but it would be going forward. We would credit at the lower rate going forward.
Okay,
We would
so
not see a decrease in
it would grow
balance.
slower,
Right.
but I wouldn't see it drop.
We're not going to do a retro. Doris, how you agree, right? Yeah, it would be forward only.
Could we do a retro?
I wouldn't try it.
Okay.
You're sitting next to a lawyer. Yes.
I think it would be,
Yeah,
but.
that's going to be a tough one.
So as far as today is concerned, obviously this is to receive and file. There's no action item associated with this. But it is very curious to, I think, multiple trustees on this board of the numerous options we're going to have to consider in the next few months.
And we will bring back the policy, and we can further discuss the merits of whether or not to use a lower member crediting rate, which is currently in our draft. And if so, what mechanism or item will we tie it to determine that? And then secondly, also we'll have the discussion about whether or not the board wishes to keep the contingency reserve that is no longer statutorily required, since we do not have any supplemental ad hoc benefit plans.
And both of those would obviously directly impact the employer contribution rate.
The employer contribution rate would actually go down if we eliminate the contingency reserve, and that actually is a recommendation in our policy. It is a one-time effect because once it becomes part of the valuation assets, you don't see that effect, again going forward. But it would be affect the next valuation, not the June 30, 23, but the June 30, 24 valuation if we make this change.
But we're talking 1% of our overall fund value.
Right,
So it's
Yeah.
whatever
Significant
million.
amount of money.
Significant amount.
Yeah.
Yeah, I think the reality is like Doris indicates, so it's a $6 million amount, it's a one-time only impact, a reduction in the unfunded liability, but as the board is aware, anytime there's a reduction in the unfunded liability, we take the amount and amortize it over 18 years. So actually, this $6 million will continue to give for the next 18 years. So there would be more or less a not quite $500,000 reduction in the employer's contributions, but close to $400,000 if I have to guess.
Every year for 18 years.
Every year.
Okay.
And on the member crediting rate, again, remember, all it does is change the amount of benefit that is paid out to the 85% of the people under 5 years and the 25% of people with over 5 years. So that will have some impact on the employer rate, but pretty small. Affects the members more than it affects the employers.
Okay. Any other comments, questions, concerns? Thank you, Siegel. We appreciate your patience,
Certainly.
and as always, a very entertaining and interesting
Thank you
presentation.
very much.
And do we have any public comment regarding item number 5?
There is no public comment.
Okay, that takes us to item number 6, option 4, retirement benefit allowance educational presentation by our Executive Director, Rentschler.
Judy, would you bring up that presentation?
And for housekeeping purposes, we will call item number 4 after this.
So a few months back, I believe it was February, and if I recall correctly, it was Trustee Jurdy asked for additional information on how the optional 4 allowance works. As you recall, the option 4 is a customized benefit where the member can designate more than one beneficiary to receive a continuance. So we're going to talk through today, if we want to go to the agenda, what is an option 4, how does it differ from other allowances, what are the requirements, what are the board's and our actuary's responsibility, and per the request at the February meeting, we'll run through some examples so you can see the effect of what an option 4 benefit does. So on the slide 3, what is an option 4 allowance and why is it offered? As I mentioned, it's a customized option. It provides a reduced benefit to the member that pays a continuing benefit to their beneficiary or beneficiaries, plural, upon their death for the remaining life of their beneficiaries. It's often used to provide benefits to both a current spouse and a former spouse at systems that do not administer separate account benefits, or to provide maybe life benefits to a disabled child who has limited or no earning potential. So the follow-up slide here is, how does this differ from the other options that the law already provides? It allows the member to designate more than one beneficiary or to designate a continuance in the amount that they specify. The law provides options that provide either a 50% continuance to the survivor or 100% continuance to the survivor. In this case, the member could say, well, I want to provide a 45% benefit or a 73% benefit or any number of their choosing. And if they had more than one beneficiary, technically they could have separate continuance percentages for each beneficiary that are not necessarily the same. There is a concept called reversion, where if you have multiple beneficiaries and one beneficiary dies, their continuance is spread out among the remaining surviving beneficiaries. We don't necessarily recommend having that in our policy. We do have an internal staff policy, but really each option 4, because it is customized, has to be approved by the board. So on the following slide under requirements, the member has to elect this option in writing. Beneficiaries have to be natural persons with a life expectancy. They have to have an insurable interest in our member's life. So again, you're typically seeing this with spouses, ex-spouses, children, domestic partners, etc., who have an interest in that member's support to their household. An option 4 allowance must be approved by the board upon the advice of the actuary. I think I misspelled that, my apologies. The structure cannot place any additional burden on the retirement system. That is a requirement in the law. So how do we accomplish that? Well, we actually have our actuary calculate the option 4 benefit, and as part of that, they're looking at the present value of that benefit structure compared to the present value of that member's annuity, you know, the member's benefit of under the unmodified option that they would have received. So what is the board's responsibility? The board has the responsibility to approve that benefit if it doesn't provide additional burden on the retirement system. And it's the board needs to make that judgment based on the advice of the actuary. The actuary is providing an opinion that basically is going to say that, yes, based on the reduction in the member's allowance, there's no additional burden on the system. I would not think that they would ever provide you an opinion where they weren't stating that there wasn't an additional burden. The entire point of having them perform the calculation is that we can ensure that they are, in terms, actuarially equivalent benefits and without cost to the system. So the last slide here is an illustration of about 8 different test cases. I do apologize that it's probably a little hard to read on the big screens, but what I've illustrated is the lights, the rows that are highlighted in bright yellow provides the member's unmodified benefit. It also shows you what the default 60% continuance would be if they had selected that option and had a qualifying spouse, qualifying domestic partner, or qualifying minor child to receive that default benefit. Under the light peach-colored line, the member's option 4 benefit shows the benefit the member would receive during their lifetime. So the member essentially, in case number 1, gives up receiving $7,200 a month and agrees to take roughly $6,300 a month in order, in this illustration, to provide 2 lifetime continuances, one to a spouse of 70% of their payment that the member is receiving, so $4,400 roughly for the spouse, and a benefit of 23% to a child, and that's a benefit of roughly $1,448. So those 2 life benefits would continue for the life of that named beneficiary. I've run several different test cases using spouses and children and parents with different ages, so you can see how it affects the calculation of the member's benefit and what the continuing benefits to their one or more beneficiaries would be. The request was to demonstrate how folks of different ages and having multiple beneficiaries would impact a member's benefit. When the member has multiple beneficiaries with high contingency or continuance benefits, their benefit goes down more than somebody who might have one beneficiary who's relatively close in age, and the benefit to the member is reduced based on the member's age at the date of retirement and the age of their beneficiaries to determine that actuarial reduction. So I did ask Siegel to stick around for this point in case any of you have any hard questions that I can't answer, but I'm happy to open it up to any questions.
Trustee Jurdy.
So the reason why I asked for clarification was because we saw an example, and it's not important about who it was involved, but there was an example recently where we approved this, and the amount to the member and the continuance was almost the same. There was very little difference between the child, and the continuance was a child. So I was trying to understand how an allowance to the member and the allowance to the designated continuance, which was the child, presumably an adult child, were so similar.
The member is designating the percentage continuance. So I could say, I want to leave 100% of my benefit to my child. So you would see that continuance be equal to the benefit that I am receiving. The important distinction is how much my benefit was reduced from the unmodified benefit to the benefit I'm receiving as the option 4, because then the continuance percentage is based on the amount I receive as the option 4 allowance. So the reduction is taken from the unmodified benefit to the member in the amount that the member receives, and is not necessarily you could see a continuance level equal to it, regardless of the fact that it's a child or a spouse or whatever else, as far as equal to what the member receives as the option for allowance. The member's taking the reduction between the unmodified and their benefit.
Well, I will share the sentiment that it seems to me that in my general thoughts that option 4 would more greatly reduce that member's benefit when they retire. But there's a few things that obviously the life expectancy of that members is calculated into this from their retirement age to when they're expected to live. And obviously if one of the beneficiaries or the only other beneficiary passes before the member, then there is no continued benefit and they only get what they agreed to for the duration of their life.
That is correct. If my beneficiary predeceases me, I stay at that reduced option 4 benefit allowance for the remainder of my life, and then there is nothing payable upon my death. I also showed an example here at test case number 7 where the beneficiary was older than the member. In this case, I was using a parent as the beneficiary, and the reduction from the unmodified benefit to the option 4 didn't seem very much at all, because the likelihood of that older beneficiary living long enough to draw a substantial benefit from the system was not high. So again, the reduction in benefit from the unmodified to the option 4 allowance that the member receives is tied on the member's age and the beneficiary age and the combined present value of those income streams based on their life expectancy. And I'm probably not doing justice to the explanation, but
You're getting a thumbs up. The last point is, correct me if I'm wrong, is the option 4 allowed to a non-contributing member since we have bifurcated accounts now?
so as you mentioned, bifurcated accounts, or we call them split accounts or separate accounts, is a way of administering a divorce order where we actually divide the member's account and give their ex-spouse a certain number of dollars and a certain number of years of service. In our policy that our board adopted when they chose to implement split accounts at our jurisdiction is that the non-member spouse only has the option to receive the unmodified benefit, and that is an unmodified benefit with no continuance. The default continuance of the unmodified does not apply here because that is an employer-funded benefit primarily, and that's really only available to our members per our board policy. So none of the optional allowances are available to a non-member spouse under a split account.
Thank you. Any other questions or comments from trustees?
Thank you for the educational update on that.
Thank you.
And any public comment regarding item number 6?
There is no public comment.
Thank you. We appreciate the presentation, and thank you for your time, Siegel representatives. We'll go backwards now to item number 4, and it'll be discussion and possible direction regarding exploring an investment opportunity. This is a memorandum submitted by Trustee Jurdy.
Yeah, thank you. So over the last decade or so, this board has shifted some of our portfolio away from low-performing bonds over to real assets. And that's very common within basically all pension funds have been doing this, foundation investments, et cetera. And in our case, we've allocated first to our real assets for real estate, and then more recently, we've added infrastructure. In conversation with the Sonoma County counterparts, they've also added more recently, they've added farmland, and are actually very excited about farmland as a form of real assets that they're actually most excited about at the moment, according to their financial advisor, their equivalent of Robert at their agency. And as part of one of my many roles is I'm also a member of the Sonoma Clean Power Board, which is it's the aggregate purchaser of power in Sonoma and Mendocino counties, providing the bulk energy electricity for Sonoma and Mendocino County, both the cities and the county in those two counties, with the exception of Healdsburg and Ukiah, which have their own municipal utilities. Through those meetings, I've realized that statewide, because of the electrification of buildings, the electrification of vehicles, there's ever-increasing number of electric production projects in California, not just in Mendocino and Sonoma counties, and that those electric production facilities are, as you might expect, they're either carbon-free or cleaner sources than we've had traditionally providing our electricity. And they also have, I can't say guaranteed because guaranteed is a really strong word, but something really darn close to a guaranteed rate of return. The Public Utilities Commission regulates utility rates, and PG&E, for example, is allowed a 10% profit, as an example, on all of their expenses. Whether it's clearing a power line, they get a 10% profit on their expenses for that. Whether it's energy production, the expenses they have for that, they're guaranteed a 10% rate of return. So there's a lot of margin in the electric utility business. And it's a very reliable source of revenue, although you can see with an economic decline, you can see a little dip in electric consumption. The trend line is definitely going up in electric consumption, and it's not terribly volatile in the amount of electricity that gets consumed from year to year. So it kind of looks like something that looks very appealing for a pension fund. And in fact, I believe it is a small portion of our infrastructure is in utilities, or investment in infrastructure. And when I look at CalPERS and CalSTRS, I see at CalPERS, they have a whole real assets division. So, of course, they're much bigger than us, but they've got a division and a staff that is focused on their real asset investments. MSARA and SARA in Sonoma County, we're much smaller, and we don't have staff dedicated to this kind of investment. Therefore, we aren't in a position to vet any particular investment in an energy production facility, whether it's in Mendocino or Sonoma County or somewhere else in California. But I think there's an opportunity here. In my opinion, there definitely is for investment in infrastructure, investment in energy production in California, and I think perhaps one of the best ways to approach it would be for some of us who operate these small retirement systems to approach CalPERS and CalSTRS and say, hey, you have the bandwidth, you have the staffing, are you looking at some of these investments? We would, if you are, and if you would be willing to include the smaller plans in these investments, we would like to have a conversation with you about this. So it's basically just an outreach. I, as an individual board member of this board or as a county supervisor, don't really have a way of approaching CalSTRS, but I think if it's agency to agency, I think at least that dialogue could start. So I'm requesting that we direct MSARA staff to approach CalSTRS and CalPERS to see if their real assets division would be interested in possibly including us in some of their real asset investments. We already are. I did notice that Sonoma County and ourselves are both using an infrastructure investment company, IMF, which was actually formed by a number of pension funds, I believe started in Australia. And so we're already getting some benefit. That model already exists through IMF, which I don't want to discount them. Maybe they're a better pathway than CalPERS or CalSTRS, but I just thought, it couldn't hurt to also talk to the home team.
Understood. So your request would be for direction to staff to start those conversations to see if there's any interest from CalSTRS or CalPERS in investment opportunities in this area. Is there any comment from trustees regarding that request? I think it's a prudent step, and I appreciate your dedication to continually trying to find different alternative investment strategies, and I agree that the first and most important step would be to start that dialogue and see if they are interested, so I support that request. Is there any public comment regarding this item?
There is no public comment.
Is there any question from staff regarding the request to start that conversation?
I would just wonder if you guys have the time, if it's consistent with your staffing, to do this kind of outreach.
Our staff has not done this type of outreach before. the initial discussions may not require significant time. It may require eventually some determination from the board. We, as a retirement system, have not pursued any direct investments or really any local investments, and they're not prohibited by our policy, but it's not explicitly stated if the board has a preference to move in that direction. Again, we've never moved in that way. We focus on public managers, and so we can certainly start the conversation, and I am happy to reach out to PERS or STIRS or have Robert reach out with me to those agencies. But again, eventually it may be a part of a board discussion about whether or not you want to move into direct investment. That could require some additional time as far as compliance for reporting purposes.
I understand that, and again, I don't think there's any harm in asking if there's interest, and if or when we find out that there may be, then it would have to come back to the board for direction and or action to include updating any policies that may need to be updated. So I see this as more of the preliminary steps, and I think it's appropriate. So is there a timeline that we're looking for? Okay, just whenever you have information, then you can agendize it and bring it back to the board.
Okay.
Thank you, Trustee Jurdy. That brings us to item number 7, fiscal year 2023-24 preliminary quarterly budget update. Financial Investment Officer Reveles.
Trustees, you have the preliminary final budget update for fiscal year 23. I've got a memo, typical memo, and reports, and I'd be happy to answer any questions you may have.
Any trustee conversation regarding the memorandum and budget update? Are there any public comments regarding item number 7?
There are no public comments.
Well, Robert, I always feel bad because you always put a lot of work into your memos and we don't usually have questions, so I guess you do a good job, but I do appreciate the hard work.
Thank you very much. I don't expect there to be any major changes. Some of that's estimated, but I think it's very close. We'll bring another final update once we get through year end, probably the end of next month, maybe October.
Thank you. We'll received and filed on that item. Brings us to item number 8, discussion and possible action regarding policies scheduled to review. There's 3 different policies under A, B, and C.
And Chair, I would like to apologize. The board memo, the cover memo that got attached was a earlier version that only listed 2 of the 3. There are 3 policies that were included in the updated version of the memo. We do have the MSERA trustee education and travel policy. There are no substantive or any changes to that. It was just indexing it for the date reviewed by the board and readopted. On the portable electronic device policy, there has been the addition of item 2D, email security, that talks about the MSERA trustees using the county-provided mendocinocounty.org or mendocinocounty.gov email addresses when conducting all MSERA business. There's really nothing other than that as far as a substantive change to that policy. And then the investment policy includes the investment belief statement. The only update to this policy was the board directed change to the investment belief number 3 that added the information approved at last month's meeting, looking at the financial, economic, and other risks relevant to the investment process. The board may consider risks imposed by environmental, social, and governance factors, et cetera. So that's the only change there. That language had already been approved by the board. It's just readoption of the policy. If you have any questions on any of the 3, I'm happy to answer any questions.
Any trustee conversations regarding any of the proposed policies? there any public comment regarding item 8?
There is no public comment.
I believe we need an action on these 3 policies if anyone is interested.
Move to approve the revised policies.
Thank you. We have a motion and a second. Any further conversation? We have no public comment, so we can go to a roll call vote.
Just to clarify, was that a motion just to approve the electronic device policy or to approve all 3 policies?
Well, I wanted to comment on 8C, the investment policy.
Okay.
Okay. So the motion is just the electronic device one?
Yeah.
Or, my apologies.
I misunderstood.
There's
and
the travel,
Yeah.
education and
Yeah.
travel one.
Okay, so policies 8A and 8B.
Okay. Motion to adopt 8A and 8B, the travel policy and the portable electronic device
proposed.
policy.
Does
Thank
your
you.
second still stand, Mr. Kelly? Thank you. Any further conversation regarding the motion? Can we take a roll call vote, please, Ms. Zeller?
Mr. Land?
Aye.
Ms. Cavanis?
Aye.
Mr. Kelly?
Aye.
Mr. Jurdy?
Yes?
Mr. Cromer?
Aye.
Ms. Cubison?
Aye.
Thank you. Motion's approved.
Trustee Jurdy, would you like to address 8C now?
Yeah. So I've already discussed most of what's in my memo on 8C, but in my previous comments. But in particular, there's a couple of policies in 8C that I don't believe are true. Yet we're stating it as our investment philosophy, and so it's not my investment philosophy, and therefore I don't want to vote yes in favor of it. And in particular, the one that rubs me the most is we're stating something I believe to be true. I think academic research bears it out, and that is it is extremely rare over a long period of time for an actively managed fund to outperform the indexes. However, I do not believe it's true that that you cannot find index or actively managed funds that closely approximate the indexes with significantly less volatilities, i.e. standard deviation, or drawdowns in bad markets. And if that was our goal, if that was our measurement of actively managed funds, which was, in my view, a more holistic evaluation of an actively managed fund, rather than simply can it beat over the long term an index fund, I think we would have a different perspective on our portfolio. Because as I pointed out, and I'm not aware of all the funds out there. There are thousands of mutual funds. I'm only aware of the funds I've read about on Morningstar and other sources. But a very well-known fund that I've given an example, the Vanguard Dividend Growth Fund, which is really a screen for highly profitable companies. It's not a screen for the biggest dividends. It's just companies that have had 10 years or more of dividends and are highly profitable, highly stable companies. Just, and as an example, picking that fund allows you to have a portfolio that roughly, does not equal, but roughly approximates the stock market in performance, but with a lot less drawdown and a lot less standard deviation. And as I pointed out, then on your fixed income section, you could have a slightly higher standard deviation, a slightly higher drawdown in your fixed income portfolio, and together they do significantly outperform a traditional index fund for stocks and a traditional bond-only fund. And the examples I've given are, again, the Vanguard Dividend Growth Fund, which is actively managed for Vanguard at very low costs by Wellington, and the Vanguard Wellesley Income Fund, which is 60% investment-grade bonds that are actively managed and 40% actively selected, a little over 100 companies that are purchased at a good value that have yields, dividends that are slightly higher than the S&P 500. That's their screen in the Wellesley Fund. And as a point, as an example, for in the last 20 years, which is a pretty long time period that I selected, every 100 million invested in with just those two changes in our portfolio, we would have yielded for every 100 million invested in the last 20 years, we would have had 61 million in additional revenue to our fund, versus the indexes. So I think that the statement that only goes as far as to measure actively managed funds against the benchmark of do they beat the indexes, I think is an incomplete analysis of whether or not it is worthy considering an actively managed fund. The other part of it is it's also reasserting one more time that as if it's a magical number, 21% of our portfolio should be in fixed income. And I think there's nothing magical about 21% of our fund being in, and I think if we have less volatile equities, we can have slightly more volatile bonds, and we will have no net increase in volatility in our portfolio, as I've shown with this 20 years of performance, and we would have higher total performance.
Thank you, Trustee Jurdy. Can I ask the first one that you don't agree with? What exact section is that on this policy? Do you know where it is? I was looking under the investment beliefs versus the investment objectives, and I'm having a hard time finding that statement.
May take me a minute to find it.
Okay.
I don't know if Doris finds it before I do.
I wasn't able to find it right off the bat either. I was continuing to look for that. Maybe it's under diversification add value, belief number 2, that MSARA, by reducing the volatility of investments in both the long and short term, it doesn't talk about active versus passive management there, so I'm not sure exactly which items you were wanting to potentially modify. Just for our newer trustees, the first part of the policy are some belief statements and general guidelines about how the board has typically viewed the market in the past. Section 2 is investment objectives as far as our long-term goal. The board adopts the asset allocation typically every 3 years after an asset liability study. We completed that process earlier this year, and the target allocations on page 13 were adopted in April based on that board discussion and adoption of those at that point in time. It does not talk about active versus passive or
I think that may be under page 6. Public investment markets are largely efficient, item 5. Could that be it?
I would have to defer to Mr. Jurdy on that.
Yeah, I think that's where I was looking at.
Okay, so it does reference the broad market index, and that many of the public investment markets in which MSARA invests are highly efficient and the most information is freely and widely available. It's difficult for investors to add value net of their fees above the returns of a broad market index, especially in the long run.
And I think in reading this, it looks to me like the only definition of value is net returns. And I'm saying there is a value to having reduced standard deviation, reduced volatility, reduced drawdowns. That's also a value to a portfolio.
Okay, well, my personal stance on this is I know that this item had come back with the ESG terminology added to it, and I know it's in there, and I'm not personally prepared to make significant changes to our investment policies without further conversations and input from Callan and our own financial investment officer. I understand your concerns, Trustee Jurdy, but I don't know that we have to take action on item 8C, and we can give direction to staff if we would like to have it brought back with potential changes or even have it re-agendized for more further discussions.
Even if it's adopted as is, we can bring it back in any month
Okay.
with, for a discussion and potential action. There's nothing to prevent it from being, modified and readopted, next month or 3 months from now. So certainly if there's specific direction or language that we want to look at maybe including and involve Callan, et cetera, we can certainly agendize that to bring it back at the board's pleasure as time permits.
Well, I will make the same statement I made last month, that we can consider many different things. It doesn't have to be articulated in the policy. I understand the desire for numerous trustees to put ESG in there, but I found it somewhat frivolous, so I will still entertain a motion if there's anyone that's a trustee that would like to make a motion regarding 8C.
Well, I don't want to go too far against what the board wants to do, but could we, I would support just tabling this item until, there needs to be some discussion at some point from the board about this. I'm articulating a case.
And
Maybe I'm wrong, maybe I'm right.
This is a larger, policy statement. It doesn't get down into necessarily the specifics of the allocation between active and passive management and things of that nature, which is a separate discussion outside of the policy, I think. But we can certainly look at incorporating some of your concerns into the policy, and I'm happy to bring it back. And if you want to provide some suggested language or something, that might help give me a direction to focus those changes on. And I believe there was a comment from Mr. Kelly.
Trustee Kelly.
I note in that section 5 here, the word will occurs. It would be nice if that was should.
Section.
I think this is your real question, is it not, Dan? That the board must use the term will, where it would be just nice if the board would consider, and that's the should word.
Although I think it's only referring to the market segments, which I think they're defining as small and mid cap. And I'm saying even in the large cap spectrum, while I'm not saying an active manager will outperform the index, I'm saying that I do believe there are large cap active managers that are roughly approximating the market, but are doing it with less volatility and smaller drawdowns. And so I think it's referring in this case to only the small and mid.
Well, I have no personal issue with tabling item 8C, that policy with direction given to staff and potential suggested language or changes to be communicated to the executive director so they can be brought back for an agendized item and conversation. Is that sufficient direction?
Yes, thank you.
Okay. I think we already asked for public comment on 8, did we not?
There is no public comment.
Thank you. That brings us to item number 9, discussion regarding the administrative report.
Thank you, Chair Cromer. In the administrative report, I've mentioned that we do have an upcoming election for general member seat 3 and both the retired member seat 8 and retired alternate seat 10. The notice of election will go out this afternoon after today's meeting, and the election time schedule has been provided as an attachment. As far as updates on our pension gold administration system, we completed the testing and input the general ledger and actuarial releases into production, and I am working with LRS now on the scope of work for implementing the separate accounts. After that, we'll deal with the service purchase function correction. I do not have release dates for those yet. I did attend the International Foundation of Employee Benefit Plans Fraud Prevention Institute. I did find it very informative as far as some of the ways to evaluate service providers, and hope to be able to incorporate some of that information in our process that is part of our strategic plan about risk assessments. I did want to bring to the board's attention an upcoming training opportunity. The NOSSAMN 2023 Pensions Benefit and Investments Fiduciary Forum is going to be held at their office. They have 2 sessions. It's a one-day event either in San Francisco or in Los Angeles. The San Francisco one is held on October 5th. They are limiting attendance to no more than 3 individuals per system, per location or venue. So if we had a lot of people who did want to attend, some of them might have to go to the LA one. The conference registration fee is $95. I did attach the information on it. I did attend last year's forum, which happened to be virtual. My scheduling, I am not sure if I'm going to be able to attend this one, which is only being offered in person, but it is open to trustees and council and investment personnel also. So if anyone is interested, please contact Judy. And one of the highlights that I'd like to bring to the board's attention is that MSARA has received the Governance Finance Officer Association's Certificate of Achievement for Excellence in Financial Reporting. Once again, we've pretty much received it every year. We've submitted the ACFR, the Annual Comprehensive Financial Report. I would like to thank Robert for his efforts on a job well done. Each year, the GFOA provides a detailed list of comments and suggestions, and our only 2 comments on our ACFR this year were very minor, and that was to update the use of the term fair market to market value and replace an old reference to the CAFR with ACFR. We missed apparently a couple of those updates in some of the footnotes. So I just really want to thank Robert because he did an awesome job. Also, we have Sacker's legislative update attached for your reference. If you have any questions on anything, I'm happy to address them.
Thank you, and I know we have come to expect this award, but we shouldn't because I know it involves a lot of work, so thank you for all the dedication and hard work. Just because somebody's an all-star every year doesn't mean you can expect it, so thank you. Any trustee comments or questions regarding the administrative report? Any public comment?
There is no public comment.
Thank you. We'll receive and file your administrative report. Thank you. That takes us to item number 10, which is discussion and possible action regarding the employment agreement with Doris Rentschler for the position of Executive Director. As far as a report out, the board met in closed session last month and gave direction to the negotiations team. And that negotiations team met with Executive Director Rentschler. The agreement that is being proposed is consistent with the board direction that was given to the negotiations team and agreed upon by Doris. And the quick rundown is it's a 3-year contract with increases of 3%, 2.5%, and 2.5% over those 3 years, to include any other additional increases department heads may receive during any increases allowed under the department head MOU. And if approved by this board, it would be then sent to the Board of Supervisors for approval as is required by the SURL. So I don't know if any of the negotiations committee, you're the only member here today.
Yep. I know that everyone on the negotiation committee supports the recommended action, and I would move to recommend approval of the item.
So we have a motion.
I'll second.
We have a motion and a second. Any further conversation from trustees regarding the motion and second? Is there any public comment regarding this item?
No public comment.
Ms. Zeller, if you take a roll call vote, please.
Mr. Land?
Aye.
Ms. Cavanis?
Aye.
Mr. Kelly?
Aye.
Mr. Jurdy?
Yes.
Mr. Cromer?
Aye.
Ms. Cubison?
Aye.
Approved.
That takes us to item number 11, which is an opportunity for general board member discussion. Is there any discussion from any of the trustees today? I know that Ms. Zeller has been busy sending out reminders on maybe some overdue training, so I know I owe one, and please pay attention to your email if you get any from her as a gentle reminder to complete any trainings that are required or overdue. the only conversation I had. That takes us to item 12, which will be closed session. So we will go into closed session at this time for two items. One is for a non-service connected disability application, and the second is a conference with a real property negotiator pursuant to Government Code 54956.8. So we'll be in closed session. Back in session for the Mendocino County Employees Retirement Association Board meeting, and our attorney, Mr. Burke, will report out.
Thank you. On item 12A, the non-service-connected disability retirement application of Juliana Parlett, the board voted unanimously to grant her application. On item 12B1 and 12B2, conference with real property negotiator, the board gave direction to its negotiator. Thank you.
That leads us to item number 13, which is adjournment and notice of our next board meeting, which is Wednesday, September 20th, 2023 at 8:30 a.m. And that is our meeting. You're adjourned.